morning. Yields up by another basis point on the front end, the 2-year at 5%. We had a close on the 2-year yesterday of more than 5% for the first time since the failure of SVB. Remember back in March, April time, we were talking about the end of the cycle, rates being too high, financial conditions being too tight, and ultimately growth would have to roll over. And here we are in Q3 talking about growth doing anything but. Coming up, the morning calls, and later, BlackRock's Gargi Chowdhury on what she calls the yield of dreams. That conversation 7 minutes away.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England. Kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Looking potentially at a second day of gains on the S&P 500. Equity futures positive here by 0.4%. That's the price action. Let's get you some morning calls. First up, Wedbush adding Amazon to its best ideas list, expecting growth to re-accelerate over the course of the next year. That stock is up by 0.4%. Goldman downgrading Evercore to neutral, 140 price target, highlighting the risk to near-term revenue growth. That stock negative this morning. And finally, JP Morgan upgrading Emerson Electric to overweight, seeing an attractive valuation, strengthening balance sheet, and improving visibility. That stock is up by 2%. Coming up, bond yields at multi-decade highs. BlackRock's Gargi Chowdhury on whether it's time to buy. That conversation up next. Your opening bell just around the corner.
London will stay a financial center. It will stay our EMEA hub. we'll just have a rebalancing onto the continent. And actually the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Snapped a 4-day losing streak just yesterday on the S&P 500. Can we make it 2 days of gains? Equity futures up here by 0.4% on the S&P 500. On the Nasdaq, higher by 0.7%. The fate of this market at the moment seemingly in the hands of what develops in the bond market. The opening bell rings in New York City. Switch on the board and get to the bond market. Yields up and away this month by more than 40 basis points, close to 40 basis points higher on a 10-year specifically. 434.40 on a 10-year this morning. Yields we haven't seen in this cycle in the last 24 hours. Yields we haven't seen going all the way back to 2007. In the FX market, the dollar stronger, the euro weaker, 108.59 on that currency pair. We're negative by 0.3%. And crude just a touch higher, up by a little more than 10 cents, up by 0.15% to $80 and about 84 cents. The broader market, we're doing okay about 30 seconds into the session, up by 0.4% on the S&P. On the Nasdaq here, up by 0.7. One stock to watch at the open is Macy's. The retailer topping earnings estimates, but delivering another warning about the US consumer. The CEO saying, quote, "We continue to see uncertainty in the macroeconomic environment." Abby has more. Hey, Abby.
Hey, John, and it's all weighing on the shares in a big way right now, down about 9%, the worst day since June of 2022. And how often do you see a company beat adjusted earnings by 93% and the stock falls in this way? Well, in the case of Macy's, we're talking about small numbers, 26 cents per share versus the estimate of 13.5 cents. But more importantly, it's the composition of the earnings, because markdowns, seasonal markdowns on spring and summer merchandise, that was what drove that earnings beat. Relative to sales, they did beat slightly, but it's another quarter, I think the fifth quarter in a row of negative growth, down about 9% year over year. And we do have, as you mentioned, CEO Jeff Gennett pointing to that macro uncertainty. Yet another company here, John, this is really interesting, a theme that's emerging. They are expecting added pressure as the student loan forgiveness expires, that is going to weigh in terms of discretionary spending available from those with those loans. As for Lowe's, well, this stock is popping. Analysts are saying that it bested Home Depot, and it literally did in terms of sales comps, down 1.6%, much better than Home Depot. Plus, they have driven by a strong spring recovery in online sales. They reiterated their annual guidance. That's a positive. This stock now up 10% year to date, beating, I think, Macy's on the year, but certainly Home Depot, which is up closer to 2% on the year.
Abby, thank you. That issue around student loan repayments, we heard that as well in the last week from Walmart, from Target. Interesting, because there is a one-year on-ramp to those repayments. So you just wonder where exactly that falls in the calendar year over the next 12 months or so. Let's stick to earnings. Zoom Video raising its annual forecast. The CEO highlighting the company's progress in AI, writing this: "We continue to innovate with new AI features like Zoom IQ meeting summary and intelligent director. I'm proud of the team for reinventing modern customer experiences." Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Actually, Zoom is open markedly lower, down 2.5% currently, had briefly been down more than 3%. Revenue for the year, the fiscal year ending in January 2024, will now be as much as $4.5 billion. That's a modest adjustment higher for the previously stated guidance that Zoom had given. As many analysts note, what Zoom has done well is use cost cuts and, as you mentioned, AI internally to boost the bottom line, and that's where the most market adjustment was. Annual earnings, excluding some items or on an adjusted basis, will be $4.63 per share to $4.67 a share. That compares with the previous forecast of $4.25 to $4.31. The story is really clear. There was a lot of enthusiasm and optimism about the enterprise side of the business. If you look at the period just gone, which was their fiscal second quarter, revenue was up 10% to $659.5 million. But there's two diverging paths here. Sales to consumers and small businesses actually fell in the quarter 4.3%. So that growth of 10% year on year in the quarter just gone is mostly all just enterprise. Other non-video products like Zoom Phone, for example, starting to gain traction. But the stock's actually markedly lower. CFO will be on the show with me, Bloomberg Technology, later, John. And I think the question is here, what conditions are needed to return to growth? Because that is one that JP Morgan in particular is posing in its note this morning.
The kind of conditions none of us want to see, a pandemic and a shutdown, Ed. None of us want that. Yeah. Ed, all the jokes aside, big show coming up for you a little bit later on this afternoon. Microsoft Activision. Ed, just quickly, can we strike that deal? Can we close it?
Yeah, I mean, the concession that they made to the UK CMA was even greater than what I'd reported earlier in the summer, right? I had reported with colleagues that they would just fence off the UK cloud gaming business. But what they've done is gone to a competitor, Ubisoft, and said, have the global rights for cloud streaming. And we've seen the response from the CMA already in an interview with Bloomberg. They're going to look at it very carefully. These are highly unusual circumstances with the CMA looking at it a second time. But it looks like it's a big offer. And I think the chances of this deal now happening are good. It was only when I left for vacation on Thursday, John, we were pretty skeptical.
Ed, thank you, sir. Ed Ludlow, Caroline Hyde, a little bit later on this afternoon. A don't miss program going into NVIDIA earnings tomorrow after the close. NVIDIA right now, all-time high. Year to date, I've got that stock up by more than 200%. Year to date, just absolutely unreal. I mentioned Zoom. A number of analysts remaining cautious despite those strong results. Ed talked about some of the issues around it. Piper Sandler had more to say, reiterating its neutral rating and saying this: we expect shares to be range-bound with compensation remaining high and shares lacking a catalyst. Similar message from Evercore as well. We're still in the very early innings in a very competitive market, and we will struggle to find a near-term catalyst and thus remain on the sidelines for now. That stock is down by more than 3%. Let's turn to the financials. S&P Global Ratings downgrading a host of U.S. banks and saying this: the decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen. Shonali has more. Hey, Shonali.
More ripple effects to higher interest rates, John. You're looking at deposit betas rising at these banks, those interest rates being passed on to consumers, meaning that for the regional banking system, it's still expensive to hold on to client money. Now, if there is a silver lining to be found in this S&P report that downgrades another set of banks after we've seen Moody's already downgrade a number of banks, as well as put another set of banks on negative watch. When it comes down to S&P, they said 90% of the banks that they rate have stable outlooks, while only 10% have negative outlooks. So the rate of change of bad news for these banks might be starting to pair off, although clearly they are still feeling the pains of this interest rate environment. S&P's analysis showed that interest-bearing deposits have fallen 23% over the past 5 quarters for the banking group. And if you take a look, since the last downgrade for KBW's bank index, the drop has been about 7% out of a 19% drop this year so far. Now, there's another implication here, that's for the bond market. When you take a look at these banks, a lot of them have already been tapping the bond market. When you look at the bigger banks, this is $2 trillion raised globally in the bond markets for the big banks that are trying to shore up more capacity. When you look up their total loss absorbing capacity, these are regulatory standards they need to meet. It becomes more expensive for these smaller banks with lower ratings now to keep tapping the bond market. According to Bloomberg Intelligence Analysis, they expect U.S. Bancorp and Truist among the banks to keep tapping that market. But again, for the rest of the group, question about where they get their money moving forward.
Shonali, thank you for the update. Let's stick with the financials. The latest on Schwab, planning to cut jobs Downside is real estate to achieve at least $500 million in annual cost savings. The spokesperson saying this: we intend to take a series of actions aimed at removing cost and complexity from the firm. This will result in eliminating some positions in the coming months. Katie has more. Hey, Katie.
Hey, John. Yeah, Charles Schwab responding to investor pressure with those plans to lower costs. The company said Monday it will either close or cut down on its offices and reduce its headcount, mostly in non-client-facing areas, according to that spokesperson. And as a result, like you said, Schwab expects to incur costs of roughly $400 to $500 million, but that's en route to saving about $500 million annually. And Schwab followed up on that announcement from Monday with a multi-part bond sale this morning. John, will be really interesting to see how that's received. And of course, Schwab has come under a lot of pressure in recent months alongside those mid-sized banks. And it said earlier this month that it's temporarily seeing lower net flows from clients. You've checked in on shares this morning. They've been hovering between gains and losses. If they do end in the red, though, John, that would be an 11th straight day of losses, and that would be the longest streak since 2004.
Brutal. Katie, thanks for the update. About 8 or 9 minutes into the session, the broader equity market on the S&P 500 still just about positive for a second session on the S&P by 0.26%, up by 0.4% on the Nasdaq. BlackRock's Gargi Chowdhury highlighting potential upside within both equity and fixed income markets, writing this: we see key opportunities in the belly of the Treasury market, so the focus there on the 3 to 7 year part of the curve. In stocks, this is the view: we remain constructive on quality tilted exposures and see opportunities in energy as well. Gargi Chowdhury, I'm pleased to say, joins us for more. Gargi, I remember you called it the yield of dreams. Let's start there in fixed income. Is this the dream?
Good morning. Hi, John. It's good to be here. So definitely in the front end of the curve, and as you pointed out earlier, sort of focusing on the very front end, so say up until the 5-year point of the curve, I think it is a dream, especially if you're an investor that can stay invested for the next 6 to 12 months instead of sort of getting spooked by some of the daily volatilities that we've seen. I think in 1 year, if we look back to what is available in terms of high-quality Treasury yield in the 5-year part of the curve, I think it's going to be an excellent opportunity. We look back and think that there was an excellent opportunity to earn some income, earn some yield in our portfolios. I think if we look further out, though, looking at the 10-year point, 30-year point, I think that is probably still not safe yet, because I would imagine that there's going to be a little bit further yield curve steepening coming our way, and some more term premium getting built into the yield curve as we learn more about where the R-star might be, as we learn more about where inflation rests, and of course, as we try to digest all the supply that's coming our way.
436. New high of the session, new high for the cycle. Gargi, just go one step further with me. How would you frame the move at the longer end? Do you see that reflecting an extension of the cycle, or potentially maybe the perfect storm that leads to the end of one?
Yeah, we just wrote a paper on this because we had so many clients asking us about this move in the longer end. So a few things. In July, the long end was mainly moving because of the Fitch actions, because of the BOJ relaxation of the yield curve control, and of course the Treasury supply that I guess we knew, but sort of learning about the magnitude of that. I think more so in the last week, or a little more than a week, last 10 days, I think the recent bear steepening move has much more been driven around what I call R-star gazing, and this expectation that we are definitely going to get something around a higher level of neutral interest rates from Chair Powell and Jackson Hole. And while it's, one can never say never, I think we've heard plenty of times from Chair Powell, especially when we look at previous speeches that he himself has made at this forum, that he wants to look at more tangible data as opposed to looking at something that is not quite as measurable. So more recently, I think it is the R-star fears. And of course, needless to say, this whole time over the last 5 or so weeks, we have been getting stronger than expected data in the US, and that's also been another driver of this bear steepening. I think it's created some incredible opportunities, especially if you are an investor that can be invested in the 3 to 7 year part of the curve with an iShares ETF ticker like IEI, which gives you that duration of right around 4.3 years, which we think makes a lot of sense.
Gargi, I'll be doing tons of R-star gazing on Friday in Jackson Hole. I'm going to borrow that phrase from you, okay? Given the outlook for fixed income then, given the call you've got in treasuries, What's the outlook for the equity market against that backdrop?
Yeah, I think if you had told anyone that real rates will have moved up to above 2% in the 10-year part of the curve, and that the S&P would broadly, or at least the tech sector would broadly have, yes, weakened, but not as much as we would have expected it to weaken, given the 60 basis point move in the 30-year Treasury. I think that is showing us that the equity markets remain quite resilient. Obviously, as always, we want investors to think about certain areas that are more likely to do better. Given the volatility ahead, I will not be surprised, especially if there's more yield curve steepening, to see some more pressure on the equity markets. But I think investors that are allocating to higher quality, and what do we mean by quality? Because we know investors always ask us that, really looking at companies with strong balance sheet, thinking about companies that are able to generate very stable earnings. And we, again, saw that being very strongly, doing very well in this earnings season as well. Looking at higher quality companies that we think will be able to better preserve their principal and preserve their cash flow, really, in volatile times as well. So stay invested, look at high quality companies. The QUAL ticker from iShares does give you access to that. But at the same time, I will say that if the yield curve steepening continues to take place, if 30-year yields go up another 15 to 20 basis points, I would expect the S&P and broader NASDAQ and more tech names to come under a little bit more pressure. I think it's shallow, though. I think the economy remains very resilient. I think there are dip buyers waiting to buy the equity markets in any 5 to 7% backups.
Hey, Gargi, thanks for the update. As always, Gargi Chowdhury there of BlackRock on fixed income, on equities as well. Is it resilience or complacency? Marko Kolanovic over at JP Morgan calls it this. He said the following in the last 24 hours. Compared to the start of the year, investor expectations, market positioning, and the equity valuations have moved up, with soft no landing the new base case. Finishes with this: there is no more fear, only complacency. The broader market about 15 minutes into the session on the S&P up by 0.3%, with a bond market looking at yields of 4.36 on a 10-year and a new cycle high for the yield on the 10-year maturity for this cycle. Coming up, labor market power making a comeback.
Layoffs and firings are way lower than they were before the pandemic, and workers still have retained an enormous amount of leverage.
The pilots over at American Airlines negotiating a monster pay package. Team coverage up next.
In global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Layoffs and firings are way lower than they were before the pandemic, and workers still have retained an enormous amount of leverage, especially in in-person, face-to-face industries where recruiting and retaining workers remains difficult.
Economists weighing in on the labour market. It's a tight labour market where labour market power is back in a big way. Pilots at American Airlines approving a new contract that increases their compensation by more than 46% over the next 4 years. The union's president writing this. This contract is a big first step towards restoring the wages, benefits and work rules that were lost during the past 2 decades. This as UPS feels the effects from its own union deal just last month. The spokesperson saying this. We've seen strong interest in UPS jobs as a result of media leverage of the tentative agreement with the Teamsters. Let's get to our coverage. Bloomberg's Anne-Marie in DC, George Ferguson in New Jersey. George, let's begin with you, sir. Just how big is this deal that's been struck between pilots and American Airlines?
So good morning. So the pilot deal with American, it looks bigger than Delta's deal, right? Delta came in about $7 billion, American about $9 billion. But part of that, there's a differential that American pilots are being paid compared to Delta. So really, we think when it's all done, all 3 groups at American, United, and Delta pilot groups will be paid pretty similarly. It is a big deal. I mean, it's what we think 20% pay increase here in the first year, a bunch of retroactive pay. Pilots are in high demand. There's a real dearth of them. It's just going to add to the inflation we're seeing in the expense line, labor expense line for the airlines. We think up about 10% in the year, given these contracts. It came in line, like I said, with what we saw at Delta. And it's against the backdrop, we think, of potentially a slowing consumer. We see domestic fares under pressure. International doing better this summer. We're waiting for business to come back. It puts the airlines in a real challenging position, I think, if the consumer slows down and isn't willing to pay as much for airfares.
Anne-Marie, here's the good news for the White House, for the president. The good news is these companies are given these pay rises. Here's the good news again, what they aren't doing. These workers aren't striking. Anne-Marie, is that going to change anytime soon?
Well, it's a big win when you don't have workers striking, and this president wants to be the most pro-union labor president in modern history. So obviously, when you see a deal strike, this White House is likely breathing a sigh of relief. But Jonathan, there's really 2 important stories that could be developing today, and one comes to that UPS deal. Yes, a contract for a 5-year deal that was agreed upon, but has yet to be ratified. So we are going to see Teamsters workers today likely come out, and we'll know whether or not that was ratified today. And that could mean that if it doesn't get ratified, they go back to the drawing board and the bargaining table, or potentially a strike. workers are going to vote whether or not to authorize their leadership to put a strike on the table for leverage, and that would just up the ante in these negotiations and also potentially draw some stressful conversations here at the West Wing.
Anne-Marie, thank you. AMH, George, to both of you, thank you very much. Important to frame this the appropriate way. The revenge of the labour market, not just for the last couple of years, the last decade. That quote from the union there, I think it's an important one. This contract is a big first step towards restoring the wages, benefits and work rules that were lost during the past 2 decades. 2 points to emphasise. First step. Second point there, the last 2 decades. You've all been in those meetings year after year. Pay increases in line with inflation when inflation was 1 to 2%. This is about repairing some of that over the last decade and payback, if you will, for those that didn't get what they thought they deserve. The first step, I think, is interesting. They believe this is a first step. Maybe there's more to come. The equity market at the moment, slightly positive on the S&P. Let's get you some sector price action. Here's Abby.
To borrow your phrase, John, not a lot of drama here, as you would expect. We do have more sectors higher than not, with the S&P 500 up for a second day in a row. Small gains and losses, though, to the downside, making the day more risk on consumer staples and utilities. Those are, of course, defensive sectors, so they are down, again, making the growth stand out. And then on top, it's discretionary technology, and it's been tech over the last 3 days, John. Take a look at this rally that we've had. Some of the tech buyers stepping back in after options expiration is over, up 2.8%, the best since the middle of July.
Abby, thanks for that. Coming up on this program, your trading diary.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
25 minutes in here, stocks up for a second day on the S&P 500. Here's something I wanted to say, something we haven't been able to say for much of the last 16 years. A yield on a 10-year, 4.36. That's the price action. Let's get to the trading diary. Some Fed speak for you. Fed President Austin Goolsbee, Fed Governor Michelle Bowman speaking this afternoon. Then it's a busy Wednesday with US PMIs coming at 9:45 Eastern. NVIDIA earnings coming after the closing bell. And then the first GOP presidential debate in Milwaukee, Wisconsin. And finally, Jackson Hole kicking off on Thursday with Fed Chair Jay Powell speaking Friday at 10:05 Eastern Time. From New York, that does it for me. Thank you for watching Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Ira Jersey. He's the chief U.S. interest rate strategist for Bloomberg Intelligence. See if he's got some thoughts on this upcoming meeting of all these smart economists and central bankers out in Jackson Hole. Then Bailey Lipschultz, he's our markets reporter at Bloomberg News. He's give us the breakdown on this IPO of ARM Holdings. I've got some questions, so we'll see if he's got some answers. Anna Skazafava, general manager and VP at Choice Hotels, joins the show to talk about her company and the outlook for the hotel biz and all travel. But first, let's kick this whole thing off with Mr. John Tucker and a Bloomberg Business Wire.
All right, we're always data dependent, so let's start right there. I'm not sure if this is a matter of inventories or those high mortgage rates, but getting U.S. July existing home sales, let's call them used home sales, falling 2.2% to an annual rate of 4.07 million homes. As we look at the major stock indexes right now, they turned mixed. S&P 500 is up 4 points right now. The Dow Jones Industrial Average 10 points lower, and the Nasdaq 100 is 21 points higher. That is up 0.1%. And tech does remain a focus ahead of NVIDIA's earnings tomorrow after yesterday's 8.5% close yesterday. They were up again this morning. Sam Stovall, chief investment strategist at CFRA, he still sees plenty of worries out there for investors.
Well, they're all pretty much lined up in terms of yields. How much higher will the 10-year yield go? What really is causing the yield to be moving higher? How aggressive will the Fed continue to be? How aggressive will they sound when Chair Powell speaks on Friday?
Right now, the 10-year yield up 1 basis point. That's at 4.35. The 2-year, 2 basis points higher, 4.02%. Among some of the individual shares on the move, Lowe's topping Wall Street estimates for quarterly profit and comparable shares. Those shares, sales that is, those shares are up 2.4%, and Macy's tumbling after results show the company relied on markdowns to clear out a lot of their items. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. Appreciate that, as always. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We are streaming this thing live on YouTube as well, so just head over to youtube.com and search Bloomberg Radio or Bloomberg Global News. Either one will get you where you need to go. Let's see what's happening in the world of stocks. Lots of movers out there.
Yeah, what happened here?
What's that?
I'm just looking at the GIP, at the intraday price chart, and you know we started up at 44.20, and now we just dropped down to 44.04 in the last half hour.
People aren't buying houses, maybe. I'll tell you who's going to help us out here is Bloomberg Equities reporter Nora Melinda. Nora, what do you got for us?
Yeah, so of course we had existing home sales data come out this morning, just a couple minutes ago, and it did show that existing home sales fell ever so slightly. That's of course got me looking at home builders. Of course we know that home builders have begun taking market share of existing homes with more people, less people willing to move from their existing homes because of the high mortgage rates. And so that's got me looking at companies like Toll Brothers. Toll Brothers is a luxury home builder, and it actually reports its third quarter earnings results post-market today. And it's a little bit kind of in a class of its own in the sense that, you have Lennar, KBH, and all these other home builders that target, first-time home buyers and make it a little bit less expensive, but Toll Brothers is on the luxury end. We actually had a Barclays analyst, Matthew Boley, say that they forecast that third quarter earnings will be up about 79% year over year, but down about 3% quarter over quarter. And so that's a really interesting statistic in my head.
And these stocks have had great runs. I mean, on a trailing 12-month basis, they're all up 70, 75%. So nice run for the home builders.
Yes, Toll Brothers is up more than 50% year to date. Yep. So lots of action in the home builder space. They've really just been on a tear.
And I guess if fewer people are willing to sell existing homes or used homes, as John Tucker puts it, which is very bad marketing, by the way.
Yeah, there's the pre-existing.
Yeah.
I like used.
That's great. That's great for the builders, right?
Right.
Because if there's no supply coming on from you and me, they put up the new stuff, and that's the only stuff you can get.
It's like no competition.
Yeah, exactly.
Hey, but here's my thing, and maybe this is just a New Jersey thing. There's no roads to carry these people. Like they're building all this stuff in my town. I'm like, where's this traffic going? I don't know where it's going. So maybe that's just a Jersey thing.
Is this Jersey Shore talk?
No. This is North Jersey talk.
You're not aware, but we've been reprimanded and told we talk about the Jersey Shore too much.
So you got to stop.
We've decided to start talking about Long Island more.
Ooh.
Yeah.
Love to learn more about that one.
Oh, God. All right, what else you got for us?
Yeah, so looking at Lowe's, as we're talking about home builders,
right.
Let's talk about some of those companies. So for Lowe's, their results came in stronger than expected, outperforming Home Depot ever so slightly, but it really does show that fears aren't building as much going into home builder earnings, which, of course, as I said, Toll Brothers will report post-market today, but most home builders don't actually report until toward the end of September for the third quarter. But it is interesting to see Lowe's, Home Depot, and those stocks, up, and it really does create a positive picture when you think about the home building space.
Matt, you're a homeowner now. Are you kind of a handyman around the house?
Well, I mean, I try. I'm no John Tucker, but
no. Who is?
Did you ever buy that table saw?
I'm looking at a saw stop right now as we speak.
They're expensive, but
they're
great.
very expensive. So that's why I haven't pulled the trigger.
It's a big ticket item for a Lowe's or
right away.
Home Depot.
Yeah, but I am stuck in the house that I bought, right? Because it was like already more than I could afford. Plus,
but you got the low mortgage rate.
Plus, I got a low mortgage rate. So I just can't leave unless I could sell my house for the price I bought it or more, and everybody else's house drops in value.
Good luck with that one.
And rates come down. So yeah, like if right now I have a baseboard situation going on in the pool house. One of the baseboards broke off.
Pool house, John.
So I've got to.
Do you have a pool house problem, John?
I have a backyard with a septic tank.
In any case, let's get to the tech stocks. What's up with NVIDIA? I mean, I know the earnings aren't out until after the bell tomorrow, but we still have this stock kind of driving markets, it was up earlier, 2.5%, and now it's down.
Right. It hit an intraday record high this morning at the open. And as we know, NVIDIA has really been a bellwether in that space.
Yep.
Tech really has driven a lot of the gains this morning and off of yesterday as well. But, as we think about everything on a monthly basis, of course, we've been rallying for 2 days straight. But on a monthly basis, we're not doing so well for August.
Okay.
So I think, if I'm not mistaken, we're down about like 4.6% monthly for the S&P 500, and that's like the worst monthly performance since last year.
It's just a little breather for the market. That's how I'm taking it.
Exactly.
We just spoke to Ash Alankar at Janus Henderson out in Denver. He's still pretty bullish on this market. He made some good points here. But I think for NVIDIA, we just had Mandeep Singh on, the tech analyst from Bloomberg Intelligence. And we were saying, boy, these guys better not only beat, but beat big time.
Right.
This stock is just ripped. It's at an all-time high. And I'm going to be really paying attention to what they reported for the close tomorrow, because it's not just for the company and that sector. I think it's for the market. I think it's got implications.
Expectations are high.
Yeah. So, all right, we'll pay attention to that one after the close, because that's going to be a big one. Nora, thanks so much for joining us here. Nora Melinda, she covers all the markets for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. And we want to talk to Ira Jersey here. We'll get to soccer with Ira, because the seasons are back in full force over in Europe, and Messi's just tearing it up here in the U.S., probably even outperforming expectations. But let's talk a little bit about the Fed and rates and so on and so forth. Ira Jersey joins us. He's the chief U.S. interest rate strategist for Bloomberg Intelligence, joining us from that Princeton campus, the HQ of Bloomberg Intelligence, the brain trust, if you will, of Bloomberg Intelligence. That's where we created BI 14 years ago. It was down in Princeton.
Wait, were you there?
Yeah. So that was it.
Oh, you worked in the Princeton office before?
Yeah.
Was that a sweet gig?
Sweet gig.
Because you never had to come into the city.
Never had to, and we fought like crazy to be able to get to come into the city, because this is where it's at. Nobody, you got to be in the city, in my opinion. That was my argument, and we are now. So we're everywhere. Ira, you're everywhere. Everybody wants to talk to you about rates here. I see the real yield, which I didn't even know was such a thing until recently. The real yield on the 10-year Treasury is 2%. Lisa Bromwich tells me that's important. Is it, and why?
Well, I think the 2% number is just a number, but I think what's important is two things. One is we're at now a multi-year high, right? The highest we've been since around 2009 or so. And I think it tells you that investors are really demanding a premium over inflation now, whereas they weren't worried about inflation very much just a few years ago, and now, suddenly, it's not so sudden. I guess it's taken a year and a half to get here, but but investors have to demand that premium over inflation. Importantly, too, is that now that we've broken that yield high of 1.98%, there is the possibility that we can see an extension of this move to significantly higher yields. And from an economic perspective, what that means is that you're just going to see even tighter financial conditions than we've seen in the recent past.
We heard last week from Larry Summers. He was on Wall Street Week with David Weston, that he thinks we should see yields over 4.5% as the average for the next decade. It seems like a strong call. What do you think of that? Did you see the math that he did for that?
Well, so the way that you can get to a 4.5% yield is really, think about what a nominal Treasury yield is. A nominal Treasury yield is your real yield, so what we were just talking about, that 2% TIPS yield, plus whatever inflation expectations are. So I guess the question is, what do we think inflation expectations are going to be going forward? Right now, for 10 years, they're in the low twos, right, about 2.2, 2.3%. So if inflation expectations kind of hover where they are, and real yields are 2.2%, then 4.5% would not be a complete surprise. If you go back to the early 2000s, you go back to the 1990s, that's more or less where Treasury yields kind of were on average. I guess the question that we have to ask ourselves, and what investors need to ascertain, is: are we going back to an environment more like the 1990s, where we have 2.8%-ish inflation, and then on top of that another 2% real yields? Then yeah, that's completely possible. I think there's still, we're still not a lot of people still aren't completely convinced, and I'm among them, that we're going back to the 1980s, 1990s, or even early 2000s in terms of the economic environment. So unless there's no way that the Fed is able to get inflation down more significantly, then we're probably going to see yields at some point go back down. But will they get to 4.5%, say, the next cycle? Yeah, completely possible.
I think just so you know, Summers says he thinks inflation is going to trend at a faster pace, about 2.5%. Real return could be 1.5% to 2% over time, and the term premium, he said, will be between 0.75 and 1 percentage point. So overall, he said 4.75% over the next 10 years. That's
well, the TIPS yield takes into account that term premium, right? So that 2% number that Paul mentioned before was, includes some kind of term premium. The problem is when economists and a lot of people, when we try to model what is the term premium, that's the difference of, how much extra you should be paid for buying, say, a 10-year versus an overnight bond or a 3-month bond. All the measurements of that, in my opinion, are absolutely terrible, quite frankly. Yes, academically they might make some sense, but the thing is you can't trade them, and if you had tried to trade on any of those term premium models, you would have lost so much money you would have been fired 5 or 6 times just in the last 3 or 4 years. So you can't use those models as a good gauge for exactly where Treasury yield should be. So I like to look at things that can be traded. So let's look at the 10-year, let's look at the 5-year, let's look at the 2-year. And right now, if you had a judge term premium, some models say that it's positive, when in reality, if you just look at where we are with the inverted yield curve, it's not. So I'm not so worried about that, but I am concerned about investor demand for real yields. And the fact is that at 2%, TIPS might be kind of attractive if you're a long-term buy and hold kind of investor, but that doesn't mean that they can't go higher. And I think that that's important, because if you go back and you look at where we were in 2005, for example, we had around 2.5% 10-year TIPS yields. So there's no reason to think that we can't go back there, at least temporarily.
All right, so anything going to come out of Jackson Hole this week? I mean, our surveillance team will be out there for some great programming on Friday from there, and Michael McKee, I believe, is out there already, so we'll be getting some reporting from him throughout the week.
Hey, if they're all out there, it must be important.
It must be important. So what do you expect, Ira?
Yeah, just a little bit maybe of nuance compared to what Jay Powell told us at the last press conference. The problem with Jackson Hole now is that it's less useful as a signaling tool, primarily because there's a press conference at every single meeting. But it is just like a speech, right? So it does give Jay Powell and some other members of the Federal Reserve who are out there, and indeed global central bankers, right? Because it's a symposium for global central bankers to kind of highlight what the next policy action is, and there could be some little tweaks that Jay Powell might make in terms of Anna Wong at Bloomberg Economics put it interestingly, saying he's going to have his be more like Greenspan than Volcker, for example. So not necessarily going to say, hey, we're going to hike interest rates more, but more be confusing or neutral and not say much of anything at this meeting. But I think the market might take that as a little bit as hawkish, because again, I think Jay Powell will reiterate that the Fed is not going to be cutting interest rates until inflation is down and the employment situation deteriorates a lot. So neither of those two things is, those are both the necessary conditions for the Fed to cut. And we're not going to be there until sometime next year, probably in the late next year, which is one of the reasons why we've seen the sell-off in the 5-year and 10-year Treasury.
I'm looking to refinance a mortgage. You're not helping things here. Ira, Lionel Messi has, I think, outperformed even the highest expectations. Just incredible what he's doing in the Major League Soccer this year.
Yeah, it's the problem when you take one of the best players, if not the best player in the world ever, and put him in a league that has a salary cap, right?
Yep.
Like, you think about the back lines and the defenses of Major League Soccer teams, and you look at what they get paid versus, say, the people in La Liga or in League One in France, or the Champions League teams for that matter. They don't get paid anything. Like, one player might get paid what the entire back line gets paid for a year in Major League Soccer. So So it's not a huge surprise that he's tearing some of these defenses apart.
Are you going to go see him somewhere in New York or Philly? Or
I've seen him already, not playing in Major League Soccer, but I've seen him play for Argentina, and I've seen him play for Barcelona back in the day.
You've seen him play for real. For real, I guess. That's kind of what he's trying to say to us. All right, thanks so much, Ira Jersey. Ira Jersey, our soccer strategist. He's also our chief U.S. interest rate strategist for Bloomberg Intelligence, giving us thoughts on the markets. The two-year Treasury, 5.02% to park your money 2 years with the U.S. government. We'll have more coming up. This is Bloomberg. Let's get some company news right now with, I'm going to say, Lisa Mateo behind that wall.
Yeah, that's me. Good morning. Microsoft's $69 billion acquisition of Activision Blizzard has a new chance of winning approval from UK regulators after the tech giant submitted a substantially different deal to the country's antitrust watchdog. Now, Bloomberg's Alex Webb has the details.
So what Microsoft is now offering is the licensing of its cloud gaming offerings, of Activision Blizzard's cloud gaming offerings, to Ubisoft, a big competitor in the space. In the UK specifically, it has been about cloud gaming. Could Microsoft get a dominant position? It's offered now a concession that is aimed at least at reducing some of those concerns.
Now, the Phase 1 probe will now restart. The CMA has set a statutory deadline of October 18th. Right now, shares of Microsoft are up about 0.8%. Activision Blizzard up more than 1%. And images and videos made with artificial intelligence are getting tougher to spot, and that's leading to a new wave of fraud. The Federal Trade Commission, it says so-called deep fakes, they cost U.S. consumers nearly $8.8 billion a year. That's a 44% jump from the year before. Bloomberg's Nabila Ahmed says it's also costing major banks big money.
By 2025, costs for fraud detection and prevention at global banks will have risen to about $12 billion. And that's about 26% higher than it was in 2021. So you can see the rapid rise in costs.
Now, Ahmed says Deutsche Bank has rebuilt its fraud detection and prevention system. Wells Fargo, they're also overhauling its unit that works to detect these scams. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start off with shares of NVIDIA. They have turned lower. The selling comes after yesterday's over 8% pop. They're getting to ready to report earnings after the close of regular trading tomorrow. It has now become among the biggest laggards in the S&P 500 and the NASDAQ. Down right now, let's give you the updated quote, if I have it, down 0.6% for shares of NVIDIA. Anticipation of Friday's speech by Fed Chair Jerome Powell at Kansas City Fed Jackson Hole Symposium Another factor for higher yields for bonds, Powell's commentary is widely expected to be hawkish. That's according to the latest MLive Pulse survey. Some of the other individual shares on the move, Macy's, that's tumbling down over 9%. Now, among other things in their conference call, they highlighted credit problems. So that is raising a red flag, perhaps, about the health of the U.S. consumer. S&P 500 now 7 points higher. That's up 0.2%. 4406 on the index. Dow Jones Industrial Average 59 points lower. That's down 0.2%. And the Nasdaq 100 45 points higher. That is up 0.3%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you very much. We appreciate it. Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio. We're on that, what is that internet thing called? YouTube. We're on that YouTube thing.
Oh, we are? I keep forgetting.
So you can go over there and search Bloomberg Radio. You can check it all out, the live
Do you
feed.
honestly not use YouTube very often?
No, I do.
Okay, because I use it like literally every day.
Oh, yeah.
I think it is the greatest learning tool that there is. Anything you want, like if you wanted to learn about bond convexity, there's actually a bunch of people who do a great explanation of it.
And how to hang a door, Johnson, because if it doesn't shut, you need to rehang a door. I watched that video.
Just described my viewing habits.
See?
After hours.
I recently learned about a new way to tune my motorcycle.
Really?
You just drive it at extremely high RPMs for like 20 or 30 minutes.
I thought you were banned from, now that you're a dad, from...
I'm allowed to ride bikes, just not in the city.
Yeah, so you...
And you violated that this morning.
Like you can't ride into the city.
Well, let's hope my wife isn't listening.
Exactly. All right, John Tucker, thanks so much on that. Hey, we actually have an IPO to talk about, a big one coming up here. We want to get right to it. Bailey Lipschultz, he covers all that IPO stuff and all the new market stuff for Bloomberg News. He joins us here in our Bloomberg Interactive Broker Studio. All right, so Bailey, ARM, it's part of SoftBank. They need to convince the market that as a chip designer, they are a great play on AI. How do they do that?
The big sales pitch is being in AI, being in machine learning, being in, and we looked at the filings, the company actually only mentioned AI about 50 times, but the big focus will be when they're talking to investors is how they can get and become really a staple of those chips that are going to increasingly be used to bring AI to things like your cell phone and be able to incorporate their technology into data centers, which obviously are very, very lucrative for the technology in the semiconductor space.
Now, the challenge there for me, Matt, sorry to interrupt, Matt, but is because the challenge is if I'm sitting on the other side of the table or I'm at the Rubber Chicken Lunch in New York, my thing is, but you guys aren't. So I have to believe that you aren't now really an AI play, but I have to believe that you're going to get there, right?
Yeah, and they, according to their data, are in something like 99% of smartphones. So their whole pitch is that smartphone market is drying. We've seen that play out with earnings from Qualcomm, earnings from Apple. Well, now they're trying to skate to where the puck's going to be, data centers, AI, and being able to use their technology and have customers use their blueprints, which they sell, collect royalties, some nice royalties off of other companies using that. And that's kind of where they're trying to position themselves, really. Not saying NVIDIA is one of their many customers, but they name dropped NVIDIA a few times as people who they're operating and working with and letting them use some of their AI technologies.
So what has NVIDIA said about ARM? I mean, aren't the two pretty closely connected, more than just sort of a customer relationship?
Yeah, NVIDIA was set up to buy the company a few years ago, and that deal fell apart. The big thing when you look at some of these Bloomberg reports is that ARM is talking to what they're framing as strategic investors. NVIDIA, according to Bloomberg reports, among those potential investors alongside the likes of Amazon and Intel to actually buy into the IPO. So you're trying to look at the way ARM's positioning itself to benefit from not only selling to these customers and benefiting from their sales, but also getting them to buy into the stock, which, you know, creates kind of that familial environment for SoftBank, which has had a pretty rough go, losing $30 billion last year.
Yeah, this will be a big home run for them. Great story related to this on the Bloomberg Terminal by my buddy Alex Barinka and Min Young Lee. It says ARM needed 3,500 words to explain its China risk before IPO. Wow. So they've got a China risk here, so I guess investors have to get what is that risk, I guess?
ARM laid out that they generate about a quarter of their revenue from China, and that's driven by ARM China, a unit that basically them and SoftBank are partnered with, but they don't control. So there's uncertainty around slowing demand in China, which we've been seeing play out. We've seen in the filing that the company's royalties coming from China actually slowed in the last fiscal year. They warned that that could continue to slow, and that's all on top of geopolitical risk with the US, UK, anything going on as it relates to China and Western countries. And you look at some of the reactions we've seen from Bloomberg Intelligence, really laying out that China risks paired with slumping smartphone and consumer electronic sales, those are the key concerns for investors going through this filing that hit yesterday evening.
By the way, in terms of the proceeds, this is a $60 to $70 billion valuation, right?
As far as we've reported.
As far as we've reported. Which means what? They walk away with...
SoftBank, last we've reported, SoftBank would walk away with the $8 to $10 billion because they bought back the remaining 25% from their own Vision Fund. So they're selling shares into the open market. 8 to 10, we've been reporting that maybe it's going to be a bit lower because now they own the entirety of the company. So SoftBank actually brings in all of the sales. None of that money is going to ARM's
Exactly, that's the point. So none of these proceeds get reinvested into ARM's business.
Yep.
That's an important point.
And it goes back to SoftBank being able to take that cash and redeploy it to some of the other startups that they've tried to back and are looking to back and try to create returns.
Here's another thing I wonder what our reporting is showing, because last quarter the company had little to no revenue growth.
Dropped about 1% year over year.
Okay, so given that background, is there any view coming from the street on valuation yet?
We saw, and yours truly reported on this, we saw a Bernstein note laying out expectations around $40 billion. That was last month. When we crunched the numbers, looking at some comps, we've been hearing investors in Wall Street talking up Synopsys and Cadence as better comps. When you look at a price of sales trailing on a 12-month average, valuation comes closer to 32 to 43 billion. So,
and the company's looking for what?
60 to 70 as far as we've, and they bought back that.
That's a bid-ass spread there, my friend.
Well, they also bought back with that repurchase from SoftBank. They paid about $16 billion for that 25% stake, so $64 billion baked in. But the one thing that was interesting in the filing is SoftBank warns, and this is verbatim, investors are cautioned that the purchase price paid may not be indicative of and is not intended to reflect expectations regarding the completed deal. So they basically are warning that they paid a valuation of $64 billion. Forget that. That's part of a different deal. Don't worry about ascribing that valuation.
It's funny because that's the first place I would go to.
Exactly, and that's what we're talking to investors and people who watch
this is not going to be an easy deal, is it?
It's going to be a fascinating deal. I mean, we've talked about at length about the dearth of IPOs, and the one view that I've been getting from a number of my sources is that ARM is the type of company, and they've stuck to their plans to go public this year, that could really go public in most any market. Okay. It was public once before, back in 2016, SoftBank took it private. It's more of a almost PE style play as opposed to your traditional money-burning VC-backed company.
And it's the only game in town if you want access to a new issue. If it does well, I guess there'll be a cascade of IPOs that follow.
Yes and no. We're expecting potentially Instacart to flip their S1 sometime as early as this week. Clayvio's another company. The big thing that I've been talking to my contacts, their view is fourth quarter 2023 will be interesting with some of these big companies that probably should have or could go at most any time, but the big focus is going to be early 2024 when you're going to get more of those sweet spot IPOs.
Just on a different topic completely. We were talking and have been talking for a long time with Ira Jersey about soccer, and I know Messi's come here, so it's pretty exciting for a sport that otherwise is just deadly boring to watch. Why doesn't professional lacrosse get a big pickup in this country? And I ask you, Bailey, because I've noticed that you were a lacrosse beat reporter at Citrus TV.
Yeah, man. I cut my teeth at Syracuse University covering, which I still view as probably the best men's lacrosse college team that did not win a national title. They were absolutely stacked.
Yeah, well, and back when we were kids, that was it. It was them and Johns Hopkins, and then now everybody plays.
The Big Ten's all getting in on it. No, but that's interesting, Matt, because coming from the West Coast, I knew like 2 people who played lacrosse. It was a rich kid San Diego sport that, being east of LA, was like, we play football. That's what men do.
And in Ohio, by the way, same thing. Growing up in Ohio, lacrosse was something only kids in like New Jersey and Connecticut played.
But now at the schools all the schools I got kicked out of in Central Ohio, they all play lacrosse.
Well, it's accelerating. The issue is this is the pitch, and I did a small stint covering sports here at Bloomberg in sports business. Is lacrosse is going to be gaining from parents who maybe don't want their kids to play football for fear of injuries, head injuries. The issue, the one kind of drawing factor is, and the reason it's compared to hockey is it's not a cheap sport. There aren't a lot of fields to play. So if you don't have a tremendous amount of income where you can find a stick and a ball and find someone to play with, you can't go pick up and play like soccer, or football, or basketball where there's a court or there's just a grass field. You need
and the number one high school team in the country this year, the Lawrenceville School. Thank you very much. Thank you, Bailey. Good stuff. Bailey Littrop covers the markets. Amy Marsh, she covers the world and national news in Washington, D.C. Amy.
That's right. Thank you, Paul. Former President Trump is set to travel to Atlanta Thursday to surrender in his Georgia election interference case. He's charged with racketeering in connection to alleged efforts to overturn the state's 2020 election results. And now there's a new poll out that shows more than half of voters likely to attend Iowa's Republican caucuses believe Trump's false claims that he won the 2020 election. The survey by NBC News and the Des Moines Register found 51% of respondents believe Trump, 41% do not, and 8% say they're just not sure. One leading political watcher says Trump was smart to skip tomorrow night's Republican presidential debate. Bloomberg's Nancy Lyons has that part of the story.
The former president has definitively said he will not take part. He cites his wide lead in the latest survey of likely GOP voters. The decision does not surprise Charlie Cook of the Cook Report.
Former President Trump should have his head examined if he did go in the debate. He's got everything to lose, nothing to gain from it.
As for the eventual nominees for the presidential race, Cook tells Bloomberg Sound On the only obstacle he sees preventing it from being a Biden-Trump face-off would be health-related issues. In Washington, Nancy Lyons, Bloomberg Radio.
A federal judge in Texas is taking up a lawsuit today over the so-called floating border wall. Critics say the string of buoys that are meant to discourage illegal immigration is nothing more than a political stunt. Democratic Congressman Henry Cuellar of Texas says the state will eventually have to take them down.
It's a federal responsibility. The Supreme Court has already said when they took up the case in Arizona that it's a federal responsibility.
The lawsuit filed by the Department of Justice is trying to get those giant plastic balls removed. Texas did move them closer to shore as a way to address concerns that they're floating in international waters. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks under pressure right now. Shares of NVIDIA sell off this morning after yesterday's 8.5% pop. The AI darling down close to 2% right now. This comes ahead of their earnings report, of course, tomorrow after the close of regular trading. Among some of the other stocks on the move, Dick's Sporting Goods sinking. They're cutting the profit outlook for the full year. The retailer dealing with slowing growth, and they're blaming theft at its stores. As for bonds and yields, with a 10-year Treasury this high right now, it currently is at 434 this morning. Russ Kosterich at BlackRock doesn't think this is the time to buy.
Inflation uncertainty is much higher than it used to be, at least compared to 5 years ago. And what the Fed is going to do is more uncertain. And that's what's been happening. People have been demanding that higher premium to go further out on the curve, and that could go higher still.
Existing home sales, they're down for a second month, looking at a 2.2% drop in July home resales. Data does illustrate the impact of high mortgage rates and a lack of inventory. Right now, the S&P 500 3 points lower, 43.96 on the index. The Dow Jones Industrial Average down 127 points, and the Nasdaq 100 right now unchanged, 14,937. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're doing that streaming thing on YouTube. So just head over to youtube.com and hit Bloomberg Radio. We'll get you where you need to go. That'll work.
Go to youtube.com and search Bloomberg Radio.
There you go. You're into this thing. You know what's going on here. All
right,
let's
stream us live.
Let's talk about the hotel business, particularly the extended stay part of the business, which is probably a part of the business we don't talk about enough. Anna Skazafava joins us. She's the general manager and senior vice president of extended stay brands at Choice Hotels. Choice Hotels, of course, is a New York Stock Exchange listed company. CHH is the ticker to load into your Bloomberg Professional Service. Anna, thanks so much for joining us. We appreciate you coming in all the way from Rockville, Maryland. Talk to us about the extended stay business. What are the drivers of your business, and what have the trends been, I guess, over the last several years as the world's kind of reinvented itself a little bit?
Yeah, no, that's great. So extended stay caters primarily to non-discretionary stays. So think traveling nurses, construction crews. So we have a lot of tailwinds coming to us with the infrastructure bill, the CHIPS Act, et cetera. So we see a lot of demand in our future ahead of us at this point in time. I would say the one thing about the extended stay brands is that they're pretty resilient. So even in face of recessions and pandemics, we tend to have an occupancy premium over the rest of traditional hotels. So even right now in the first half of the year, economy extended stay has a 19% occupancy point percentage over just regular economy transient hotels. So it's a very resilient business model.
I guess your biggest competitor right now would be Airbnb. Is that fair to say? I mean, if I was going to go someplace and I had to stay there for 2 weeks, that would be, sorry to say, my first thought.
Yeah, I think Airbnb, though, when we look at that, their price points are a little bit different, and those guests don't tend to look for kind of the standard guest experience that we provide across that. So the way we think about extended stay is that it's apartment-like amenities with a hotel of a flexibility. So you still get the services, the cleaning, et cetera, that you would expect from a hotel, but you have a full-size kitchen in your room. You have some of those larger spaces and suites versus a small traditional hotel room.
So are you primarily a franchise company? Okay,
Yes.
so how do you grow your business in terms, is it simply going out there and recruiting franchisees? How does that work? How does that growth?
Yeah, absolutely. But I think developers at this point in time are looking at extended stay as one of the hottest segments within the lodging industry. Really, it's a hedge. It's a really different type of asset class than a traditional hotel. So over the last couple of years, even during 2020, Woodspring Suites, our largest brand, they ran GOP margins of 50%, and they've gone up from there. So last year, we were on average at 60%. So smart money is really kind of chasing us at this point in time and wanting to get into the segment. We've been able to capitalize on that. We've had over 50% more openings in the first half of this year than we did last year. We've grown our pipeline 17% just in the first half of this year. So while we are, yes, of course, going after some of the larger developers, they are certainly seeking us out as well.
So does the does the change in work from home or the evolution of the way we work have a big effect on your business?
Yeah, we've seen a lot of stays now where, I mean, I hate the word bleisure, but where you get the business traveler, right, and they're staying for 5 days and then they tack on.
Wait, is that a word that people use?
I mean, we do in the industry, yeah.
Bleisure?
Leisure. Business and
leisure. I cannot believe that you're allowed to use that word.
It's pretty standard industry jargon for sure. It works. But that certainly has changed. And then honestly, the reshoring of American manufacturing has also been a great tailwind for us at this point in time. So any of those large semiconductor plants that you're starting to see move in, battery plants, et cetera, are also creating a lot of demand for the extended stay segment.
How about, I mean, can I build a hotel these days? I mean, the banks are just pulling back on lending across the board. How does that impact, I guess, your franchisees?
Yeah, so we're the only company that has 2 entry points into extended stay for both the economy segment and the mid-scale segment. So what we've done, knowing that new construction lending is a challenge, right? And some of our franchisees can get that. They have community banks that they've got local relationships, proven track records, and so they're still getting that lending. But a lot of folks, where we have markets that have no extended stay supply, there are a ton of traditional hotels. We came up with a really innovative solution that we call kitchen in a box. So we worked with engineers, architects, the trades, mechanical, electrical, plumbing, et cetera, and came up with this concept where you can take a traditional hotel room and convert it into an extended stay room. And we have 20 of those transformations going on across the country.
Now, what's an extended stay room entail?
So you must have a full-size kitchen.
Full-size kitchen?
Full-size kitchen.
Okay.
And the way that we like to think about it is guests use these rooms for both work, play, me space, right? They need to be flexible spaces so that it's more kind of like your home. Even thoughtful things like, you know, you want a larger vanity in the bathroom because if you're going to be there for many weeks, you want to be able to put all your stuff out, right? So that's how we think about designing that with the consumer first and how they're going to use that space.
How have labor costs been? Because I know, you know, in the pandemic or even at the end of the pandemic, Paul and I would interview hoteliers. Do you say that? Hoteliers?
That's pretty good.
Yeah. And they told us, you know, it's very difficult to get people to come to work.
Yeah. So the beauty of extended stay is in the economy segment in particular, there's only 6 or 7 full-time employees. And the reason that is because we only do housekeeping biweekly. So the labor model is super light in these hotels, which also enables those high margins that I spoke about earlier. So yes, we are not immune to that, but it certainly lends itself a little bit easier than what you're seeing in traditional hotels.
Those. So extended stay facilities are not housed within your traditional hotel facilities. They're actually completely separate.
Yeah.
Entities.
So take a Woodspring Suites, for instance. Prototype is 122 rooms, and they come standard with the kitchens, et cetera. There's also guest laundry, fitness facilities, et cetera, so that you can really maintain your lifestyle there. So that you would not see them within inside a traditional hotel.
But no, like, restaurants or any of that type of stuff? No. This is just stays? Okay.
Yeah.
Who do you compete against, really? Matt mentioned Airbnb, but in terms of the traditional extended stay, who's the competition for you guys?
Well, I mean, we're starting to see a lot of new competitors come into the space. So Marriott, Hilton, Hyatt have all announced brand launches at this point in time. I think for us, though, we've been in the space for a really long time. We acquired Woodspring Suites back in 2018 and have kind of reinvigorated the segment. We have over 400 open and operating extended stay hotels right now with another 300 in the pipeline.
And where are those? Are there regional areas that you guys are focusing on, or?
I mean, coast to coast, we certainly see a lot of demand right now in Texas and Florida. Yeah. Relocation has been big for us as well. So think places like Boise, Idaho, that are fast-growing kind of urban areas at this point in time.
Talk to us about rowing.
Yeah.
So what do you row?
She's in the Athletic Hall of Fame. I mean, that's no joke.
What's a coxswain? Is that the one that says stroke, or go?
It's a little more sophisticated now. So you actually have a microphone and there are speakers underneath the seat, right?
Really?
And so I could whisper and the crew would be able to hear you. But yes, I steered the boat and then made sure that we were making race moves.
But you sit in the front, though, right?
No, in the back.
Oh, in the back.
So you can see.
I see. Yeah. So you actually do steer, literally.
Yeah, literally.
And then you're the motivator of the crew.
Correct. Absolutely.
So what's the Athletic Hall of Fame like? Do you have like your jersey there, or?
I have my plaque, and it's on the riverfront. So we have our boathouse out there. So that's
and
where
what river is that? Washington.
Chester River, so in Maryland.
Nice.
Yep.
See, I don't know anybody who rows.
I know some row. I actually only know women who row. But
it's a big D3 sport.
It's huge.
Yeah, it's huge.
I mean, I know a lot of Boston women who row on the Charles.
That's amazing. We came in third, I want to say, one of the years on the Charles. And of course, it's a big tradition to throw the coxswain in if you win.
All right, good stuff. Anna Skazafava, General Manager and Senior VP of Extended Stay Brands at Choice Hotels. We're going to more coming up. This is Bloomberg. Let's get some company news right now. Elise Mateo.
Fun fact, I actually tried out for the crew team at Rutgers. The 5 a.m. wake-up calls, I didn't last. Now I get up at 2:30 a.m. Go figure. Macy's, they topped earnings estimates but delivered another warning about U.S. consumer spending. Bloomberg's Abigail Doolittle says, although earnings were impressive, it's all about the composition.
Seasonal markdowns on spring and summer merchandise. That was what drove that earnings beat. Relative to sales, they did beat slightly, but it's another quarter, I think the fifth quarter in a row of negative growth, down about 9% year over year. And we do have CEO Jeff Gennett pointing to that macro uncertainty.
Shares of Macy's down about 11%. Meanwhile, the Associated Press reporting that Macy's is opening more small stores in the West and Northeast to attract more customers. This month, the retailer opened a location in Highland, Indiana, and plans to open small stores in Boston, Las Vegas, and San Diego. And from retail to home improvement, Lowe's opened their books today. Bloomberg's Gina Cervetti has more.
Lowe's is seeing a strong recovery in sales to professional contractors, along with demand online. That helped the retailer report second quarter earnings and comparable sales that beat estimates. Lowe's did say it's seeing lower discretionary spending by do-it-yourself customers.
Now, checking in with shares of Lowe's right now, they are up nearly 4%. And BJ's Wholesale cut its comparable club sales guidance for the full year, missing estimates. Now, that excludes gasoline sales. Its CEO said the company will continue to monitor consumer behavior as the company forces them to tighten their spending. Now, shares right now of BJ's are down about 2%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney here in the Bloomberg Interactive Broker studio, looking at these markets mixed. We got red and green. The S&P is kind of unchanged here. The Dow's off 90 points. That's about 0.3%. NASDAQ up about 0.5%, 64 points. Again, NVIDIA after the close tomorrow, really, really important, not just for the company, but for the tech sector overall. And many strategists and fund managers are saying for the overall equity markets in general. Also, just want to call out WTI crude oil. That's off about 0.3%, sticking right around $80.50. Yields, just call out the yields here. 10-year Treasury, 4.33%. It's pretty steady right there. The 2-year will call out above 5%. 5.03% gets our attention. We will continue to pay attention to all that stuff. Right now, let's go to Amy Morris. She's down in Washington, D.C., and she's got world and national news for us.
All right, thank you, Matt and Paul. Conservative attorney John Eastman, who pushed a plan to keep Donald Trump in power, has just turned himself into authorities on charges in the Georgia case alleging an illegal plot to overturn the then president's 2020 election loss. Eastman has been booked now at the Fulton County Jail before he was released by authorities. He's expected to face a judge to be arraigned in this sprawling racketeering case. As we get more, of course, we're going to bring it to you. The Biden administration is accepting applications starting today for a new income-driven student loan repayment plan. It's a new effort to shore up student loan borrowers facing a cliff as pandemic-era benefits end. The so-called Saving on a Valuable Education, or SAVE plan, is meant to disproportionately focus on low-income borrowers, calculating payments based on income and family size rather than your loan balance. Airlines and aviation officials facing another wave of criticism after a new study showed the number of near misses at airports happens way more often than previously thought. About 300 reports of close calls involving commercial aircraft over the past year, 46 in the past month. Airline safety expert Captain Sully Sullenberger tells ABC's Good Morning America Congress needs to provide predictable long-term funding just to keep it all safe.
We're long past the date where we could define safety simply as the absence of accidents. For decades, we've had to do much better than that, but more than that. And by looking at these incidents before they can lead to harm and take effective action, that's how we keep everyone safe on every flight.
Now, the Controllers Union says that the U.S. aviation system is not sustainable. Congress needs to address staffing issues, as the FAA said that the one close call, it may be too many, but the aviation system is the safest in the world. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg, Matt and Paul.
All right, Amy, thank you so much. We appreciate that. Matt, we've been looking for, when we talk about corporate real estate in office buildings, we say we haven't seen a lot of transactions to get a sense of where this market is. Well, we got one in Chicago. Amancio Ortega, the billionaire founder of the Zara clothing chain, snapped up a luxury apartment building in Chicago for $232 million to add to his growing U.S. property portfolio. And I'm reading down in this story, and I wanted to get a sense. It was Jones Lang LaSalle was hired in 2020 to sell the building in the trendy neighborhood of the West Loop, where Google has its Chicago offices. It was expected at the time to fetch $250 million. That's according to Crane's Chicago business. And again, it traded at $232 million. So a discount, but I wonder where that is relative to maybe pre-pandemic levels, because you're trying to get a sense is in some of these big cities and commercial real estate, what kind of discount will they trade for now vis-a-vis the pre-pandemic?
Right. Now, keep in mind, this is a residential building, right, and not office space.
Yep.
So
good point. Yep.
That's where you get the big discounts. Also, in Spain, the C is pronounced like a TH. So it's, and the Z, so it's Amancio.
Amancio
Ortega.
Thank you.
I once saw his yacht floating off the coast of Canedo in Galicia.
And how is his yacht?
I mean, I don't know if he only has one yacht, but this one was pretty cool.
Yeah.
So
but when you're around like the family in Spain, when you go over there, and you're going over there again Saturday, right?
Yeah.
I mean, you don't speak Spanish, and the Spanish you do speak is probably lousy.
Well,
and no TH, nothing. You're saying, you're saying Amancio, and then the people they just roll their eyes.
That's
right?
the one rule I can't break. And the thing is, I understand Spanish.
Okay.
So I just reply in English.
All right, that's the ugly American in Spain. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, a busy hour coming up. We're going to start off. We're going to talk a little bit about the retailers. Simone Foxman's going to join us real quickly at the top of the hour because they've got some sell-offs here at Macy's. Drew Redding, he's a home builders analyst with Bloomberg Intelligence. The home builder stocks are just ripping. I guess the bottom line is we don't have enough homes in the United States. You got to build more, and let's go buy those stocks, I guess is the call. And then probably the smart conversation of the day, because this dude is very smart. Jay Hatfield, CEO at Infrastructure Capital Management, will join the program and give us his thoughts on where these markets are going and where this Federal Reserve is going as well. But let's kick things off. Speaking of smart conversations, John Tucker, Bloomberg Business Flash.
Well, thank you. S&P 500, little change right now. And a lot of the focus right now, NVIDIA, it is down 1%. This has been bouncing all over the place this morning on the eve of the quarterly results. Earnings at consumer-facing firms, they were mixed. You had a beat from Lowe's that kind of easing the fears of lower home improvement spending. But then you have Dick's plunging after a miss there for the sporting goods store. And Macy's tumbling after results showed the company relied on markdowns, among other things, to clear out their items. And ahead of Fed Chair Jay Powell's speech to central bankers in Jackson Hole on Friday, Vince Reinhardt at Mellon Investment says investors have to stay focused on higher for longer.
And the longer they keep rates on that plateau, the more effects of the prior increases in rates we're going to see on the economy. So that's the big message to hammer home to investors.
And I know you're going to talk about this coming up with the latest existing home sales data featuring more evidence housing is in short supply. So that can continue to help home builder stocks, which, as you say, have been on a month-long tear. S&P 500 right now, 4 points higher. That's up about 0.1%, 44.03 on the index. The Dow Jones Industrial Average down 102 points, and the Nasdaq 100 right now up 55 points. That is a 0.4%. 2-year yield 5.03%. The 10-year 4.33. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're also streaming live at youtube.com, where you can go search Bloomberg Radio. I was promising you smart conversation, and boy, we got to kick it off the hour right here. We're going to talk stocks with a couple really smart market folks, and we're going to focus in on what's happening out there. Jess Metton, she covers the equities for Bloomberg News, and Simone Foxman, she is Bloomberg Television, and she covers the retail space as well. So both of them joining us in our Bloomberg Interactive Broker studio, which is a good thing. Jess, let's start with you here. Kind of red and green on the screen here. We started off in the futures market looking good, but then kind of petered out a little bit. What are you looking at?
Yeah, well, I know that we are going to get into some of these retail names that Simone's going to cover with Macy's and some other names here. So I wanted to point out a note from Nick Colas of Data Trek, who I know Paul and Matt like to follow very
love Nick Colas.
closely. He's great.
Yeah.
So he had a note this morning. So he was going through and looking at some of the Google Trends search volumes for some of these back-to-school type of items here. So when you're looking at supplies, notebooks, backpacks, those are at and close to about 5-year highs there. But unfortunately, when you're looking at queries for girl jeans and then boy jeans, those are down about 24% and 5% respectively versus this time last year. So when you're thinking about some of these discretionary,
but maybe that's just a thing, like, did he check out khakis? Because maybe people are wearing jeans less often now. And just
perhaps, especially after what's happening with the pandemic, and then also things coming out of COVID, right? I mean, especially when you're thinking about some of the back-to-school type of items maybe a year ago versus, I mean, a year ago we were still probably doing some COVID tests as well. Things weren't like they are now when it comes to how things are operating, but some interesting stats.
I won't even talk to Sam.
We should ask him, though, about the khakis.
Were you even allowed to wear jeans to school?
I went to Catholic school for 8 years, and the answer was no. We had a uniform.
And at
Lawrenceville, you could wear anything.
Oh, you could wear anything you want?
Really?
Oh, really?
Yeah, no uniform. My brother had a uniform. We had no uniform. So people went really, really downscale. And then they let girls into Lawrenceville.
Ooh,
and the
okay, there
boys
you go.
upped their game
Up their
big
game.
time.
Started wearing ties.
Yeah, exactly.
got the
Just,
khakis
no,
on.
just, you know, they upped their game, you know.
I feel like I was able to wear khakis and or jeans.
Yeah, sure, why not?
I'll admit, I went to a prep school. The boys were not on the top of their game.
No?
They got used to the girls, I expect, and they were like...
Interesting. All right, hey, Simone, on these retailers, let's start with Macy's. I mean, I walk past Macy's every day going to lovely, beautiful
Penn Station.
What's going on at Macy's these days? I mean, I thought that they'd weathered the storm and they were doing well, but inventory, is that the issue?
Now, they managed inventory relatively well.
Okay.
I mean, I think every retailer had at least some inventory problem. But now the idea is, yes, they're continuing to get traffic, but the sales they are doing are mainly on the back of really big promotions. I mean, you look at Bluemercury, for example. That's the beauty and skincare area of their business. That was what held up comparable sales, up 5.8% over last year. But then you listen to the call. All about markdowns.
That's
I mean,
how you move it. Okay.
yeah, exactly. To some degree, maybe they're not having necessarily inventory issues where they have this massive glut of stuff, but the only way they're really able to sell the stuff that they do have in the stores is by coming to these markdowns. I mean, there's some seasonal issues as well, some seasonal inventory stuff. Some of this is traditional. You know, retailers they're never going to get it perfect, and as best they try and manage it, they will. But I think the concern here really is that the sales they are getting are mainly driven on the back of these big promotions, and that cuts into margin and a weak consumer.
So what are the other, I mean, the competitors, I guess, would be Nordstrom, Dillard's, right? Kohl's.
Yeah, to some degree.
Kohl's
and then
some
of the specific retailers themselves. You know, Macy's has a lot of, you know, its own private label brands, and we've heard really mixed messages. I think when we look across the space, you know, to some degree, you know, you can go to a Macy's and buy homeware stuff. They cover a lot of different areas.
I bought a couch once at Macy's. It was high quality.
Yeah.
Yeah.
There's a couch at Macy's.
You know what? They had a pretty decent furniture section there over on Herald Square, and
Nice.
now my kid brother is the owner of said couch, and likes it.
On, yeah.
I was just looking at, you know, over the last 5 years.
Oh, here we go. COMP.
Macy's has
Love it.
really underperformed the index and also the other consumer discretionary stocks. It's down 57% over the past 5 years. But Nordstrom is down 67%, and Kohl's is also down 57%. So in general, these department stores are doing very poorly.
Right. And I mean, Macy's is trying to kind of turn things around. That's been the focus under Jeff Gennett. He is leaving in the next year, and the head of Bloomingdale's, the higher end part of its business, is going to come in, Tony Spring, and come in and take over. And the idea is to make Macy's a little bit more luxurious, not the sort of bargain basement hunting through treasure trove that you might experience at a discount retailer. I mean, easier said than done, though, especially when you're starting to see weakness among that aspirational consumer. I should mention one of the improvements, by the way, coming in the textiles and housewares sector this month, adding, I think, a little bit to what we saw with Lowe's, maybe even Home Depot. People still willing to sell for their homes to a degree.
Jess, anything else you're looking at in this market? Again, kind of red and green on the screen.
I like to look at the equal weight ratio between staples and discretionary.
Okay.
So when you look at that, exactly, it bottomed at the last summer, actually. So when you see that, it's pointing higher. But obviously, when you think about discretionary, obviously including beyond just the retail names, have the home builders in there that have been on tear this year, travel-related stocks as well. But that tells you, because you'd want to have discretionary outperforming staples to tell you how investors are viewing the economy. So that has been pointing far higher here and continues to move higher. So that shows you more optimistic, especially when you look at the ECFC function, right? In the terminal, you no longer, even on a quarterly basis, you no longer see a contraction there for the economy. So Paul and I, whenever we keep interviewing people about, especially economists, about a potential recession, you're not seeing that there on a consensus perspective there when you're looking at on aggregate in the terminal right now.
I mean, again, the ECFC function kind of economic forecast. 2024 still positive GDP year on year,
Right.
0.8% is a consensus. So.
And you do equal weight to get the noise out of Tesla and Amazon, of course.
I was going to say, some of the members of consumer discretionary versus consumer staples, a lot of that seems arbitrary.
Also, it's tricky because you do have Walmart and Target, as well as the dollar stores now in the staples category. Target and those dollar stores used to be in the discretionary category with Macy's and others.
You break them. I look at each index, right? And so, in consumer staples, Philip Morris.
Right.
Is that because you need cigarettes?
Some people do.
Okay, but you don't need coffee because Starbucks is consumer discretionary.
It is.
But do you need coffee from Starbucks, or can you get it at
Well, you can get
Walmart
cheap,
/
trashy
grocery
cigarettes
store?
too somewhere, right? If you desperately need your smokes. That's a brand also. I get what you're saying, but
negotiating index composition is probably not
right.
Well, I just think it's very interesting because they've switched a lot of them.
Right.
The MSCI controls this, or
It's the GICS changes there from S&P, and so actually Target moved because of its grocery sales percentage.
Which
that's
is only
what pushed it over.
20% of its business, though.
But it was high enough to where that's what pushed it over.
Okay.
And that's actually what had held it up in the pandemic when it had been performing well, and we haven't seen it do that as much. And that's been also a big factor because of the changes we've seen coming out of the pandemic.
Fascinating discussion of index composition here, courtesy of Bloomberg Radio. Simone Foxman, Jess Menton, they're all the smart people. They can talk about this stuff all day long.
Sarcasm is the lowest form of wit.
Is it? All right, you guys, thanks very much. We appreciate hearing from you guys here. Let's talk about the home building stocks, because why not? They're just ripping here. Drew Redding, he joins us. He's a home building analyst for Bloomberg Intelligence, and he's also the master of working from home. We certainly admire that. Drew, talk to us about the home builders. What's going on here? They got to build more houses because nobody's selling their existing house, and if the prices are just going crazy here. What's going on with the home builders?
Yeah, so the home builders has actually done well to step in and fill the void left by the resale market, where we have a historically low lack of for sale inventory. So that dynamic has funneled buyers towards the builders, and we've seen over the last couple of quarters their businesses really take off. We've seen strong order books from them, demand exceeding seasonal trends. That being said, we have seen rates, we checked before we came on, we're at about 7.5% now. I think the last time we talked, which was just last week, we're at 7.25. We're up more than 100 basis points since April. So we do think that if rates sustain at these levels, we're going to have to see the builders maybe push the gas a little bit more on the sales incentives to keep traffic coming through the door.
in terms of what they're building, how's the mix look right now? Because, as Paul often points out, a lot of them seem to want to build the higher margin McMansions and not so much the starter homes that the kids need.
Yeah, that was certainly the case earlier in the cycle. Over the last couple of years, there has been a noticeable shift to the lower end of the market. We've seen a couple builders really transform their entire business model to cater towards the low end. So we do think that they're going to continue to try to make that business work, because if you think about the next several years, just from a demographics perspective, you have more and more millennials getting to what has become kind of the new normal age for first-time home ownership. That's really what's going to drive the market. So we do think we're going to continue to see the push towards the lower end of the market. And, at the same time, building smaller square footage homes is one of the ways that builders are combating the affordability challenges out there.
So I'm looking at the chart for Toll Brothers. It just recently hit an all-time high here. I mean, this doesn't look like a cyclical business here. I mean, we got interest rates, over 7%, yet stocks are still doing well. What's kind of the investment call here from this point right now? Do I put fresh money into the home builders?
Yeah, so one of the things that's been driving the strength in the builders outside of just the overall demand environment coming from resales into the new home market has been the expected trajectory of gross margins. We've actually seen over the last quarter or so, pricing power has returned to the market, which when you think of how far prices have risen, it's kind of a scary thing. But we do think they're going to be conservative on price increases. But what we have to worry about now, as I mentioned, with rates increasing again, you may see a greater use of sales incentives, which could kind of erode that margin trajectory. So in the near term, with rates at a cycle high right now, we do think that there could be some pressure relative to what we saw earlier in the year.
How about lumber? It looks like lumber had that really big move higher during the pandemic, but it's really fallen. How helpful is that to the margins?
Yeah, so lumber, the benefit from lower lumber prices, which as you would expect is the largest component for a builder in terms of construction costs, is benefiting margins this quarter, and it should over the near term. That said, there has been a little bit of a tick higher. So as you get into next year, that benefit starts to erode, and maybe it becomes a little bit of a headwind.
What can home builders do with rates? Are any of them offering deals on mortgages? Because if you look at bank rate right now, we're up over 7.5%.
Yeah, so this has been one of the primary factors driving the strength of the builders is the fact that they've been able to leverage their financing arms and offer buyers low rates. So that's 7.5 or 7 to 7.5 we've seen over the last several months. For someone coming into a new home, that's probably somewhere around 5.5 to 6%. And it's really that 5.5% is what we've heard from numerous builders is kind of the sweet spot where buyers want to be and appear to be comfortable. Now, that being said, the headline rate has risen up to 7.5. We think we're going to start to see that creep up, maybe to 5.75 or closer to 6%.
All right, Drew, good stuff. It's a good story for these home builders. And again, the stocks are just ripping. Toll just hit an all-time high a couple of days ago. Drew Redding, home builders analyst with Bloomberg Intelligence, joining us here. And it's interesting. I mean, you see it all over. But to buy down that kind of interest rate, that's pretty good incentive. I mean, if you're going to tell me I can get in there at 5 or 5.5%, and I see the bank rate thing at 7.5%, that's a good incentive.
Yeah, no, it's a great deal, and it's something that I just noticed myself. Looking through real estate sites and seeing advertisements. It's one of the ways that they can give themselves an advantage, but they have to have access to good financing as well.
Yep, and that's why I don't, these independent home builders, which is what I see generally in this part of the country, just tearing down homes, building new homes, that kind of thing. I don't know where they're getting their financing, and I got to think that's a challenge for them, and they don't have that flexibility to offer the home buyers. But so we'll see. But interesting to see the stocks have had a really, really nice run for the home builders, and you got to catch them at the right time is kind of whatever I've heard from the kind of a cyclical play. A couple of big drivers there, and obviously interest rates being one of the drivers. Looking at this market right here, the S&P 500 absolutely unched on the day. A little bit of a move down, 0.3% on the Dow. The Dow sitting at 34,350. NASDAQ, it's up about 0.4%. So no real direction when looking at the indexes. On the yields, 10-year Treasury, 4.32. The 2-year, 5.03% on your 2-year Treasury. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. The biggest stock debut of the year could be coming out of the chip space. ARM Holdings, the British chip designer owned by Japan's SoftBank, has unveiled its filing for an IPO that could value the company at $60 to $80 billion. Bloomberg's Alex Webb has more on where ARM stands in the chip space.
Look, a lot of people will say that ARM is one of the kind of core pieces of the chip industry, that if you believe in the long-term health of the chip industry, you have to be in ARM in the same way you might have to be in TSMC and the same way you might have to be in NVIDIA. They have been trying to strengthen their positionings in, for instance, data centers. Whether it can continue to grow at the pace that it was 5-6 years ago, even before it was acquired by SoftBank in 2016, that is a bigger question.
And since we're talking chips, we'll check in with shares of TSMC right now. They're up just a fraction. NVIDIA shares right now, they're down about 1.5%. And Google's YouTube and Universal Music are joining forces with artists, including the estate of Frank Sinatra, to take on artificial intelligence. Bloomberg's Kimberly Adams has more.
The newly formed Music AI Incubator will explore and offer feedback on AI-related tools with the goal of getting more artists involved with the technology and help prevent the use of voices, instruments, or likenesses without their authorization.
And shares of Alphabet right now down up about 1%. And Zoom says it sees better profits and sales ahead. It's planning to sell more products to large businesses, everything from customer service systems to chat features, fueled by advancements in artificial intelligence. Now, the company has already invested in AI startup Anthropic and said it would acquire WorkVivo as well. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, stocks struggling for a direction. Major averages, they have turned mixed. NVIDIA, that's been bouncing around after its 8.5% rally yesterday. Analysts say they had better meet their $11 billion sales forecast. Otherwise, could be a chance of a nasty correction. National Association of Realtors saying sales of the previously owned homes falling 2.2%, an annual rate of 4.0 per million in July. That is a 6-month low. Right now, the S&P 500 2 points higher. That's at 4402. The Dow Jones Industrial Average 99 points lower. That's down 0.3%. The Nasdaq 100 still up 53 points of 0.4%. The 2-year yield 433. The 2-year yield 5.03%. The 10-year is at 433. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Matt and Paul.
Hey, John Tucker, thank you so much. We appreciate that. You know, Matt, I don't know about this whole, yield curve thing. It's, I'm an equities guy, so this is kind of something new for me. But Lisa Abramowitz has been schooling me for years on this. And the latest thing she says I have to focus on is this real yield for the 10-year hit 2%, the highest in a very long time, I think since 2009. What does that mean? I don't know. So I'm going to ask somebody who's smart about this kind of stuff.
This is what the Fed wanted, right? They said they wanted to get real yields positive. At the time that Powell was complaining about it, they were negative.
Yep.
And now they're way up there. So the question is, are they then able to achieve their goal of reducing inflation to 2%?
And let's ask somebody about that. Jay Hatfield, he's the CEO and founder and portfolio manager of Infrastructure Capital Management. He's been kind enough to join us here in our Bloomberg Interactive Broker Studio. So, Jay, talk to us about your call on inflation. I got this real yield thing at 2%. That's the highest since July of 2009, so that gets my attention. What's going on out there?
Thanks, Paul and Matt, for having me on. Well, we actually think that the Fed is a little bit out of play right now.
Okay.
So in other words, they may or may not raise one more time. We don't think they will. There was a story in the Journal today, but we did some data in preparation for this. The labor market's really weakening. About 60% of jobs added are in the medical sector. And we all know that that's more of a secular increase than cyclical. And also wages are attenuating. So I think that data, we don't think the Fed's going to raise. They don't know that yet, but they're going to get some more data, particularly on the labor side, even though that doesn't really matter, but that's what they focus on. And also, inflation is going to gradually cool. The measurement of inflation already has cooled, but the measurement of inflation will continue to cool. So we're optimistic that the Fed will not raise again, but we're very concerned about the ECB, in case you want to talk about that, because we think that's critical to...
Well, let's get to that, but I do want to talk about your view on inflation, because you have your own index, CPI-R. I'm looking at it on the infrastructure, on infracapfunds.com on your website. How do you see this working out in terms of inflation? Is it really going to come back down to 2%? And is that going to be anytime soon? Maybe they hike one more time, but do we hold at that level, or are you worried it bounces back?
Well, the two things to focus on in terms of potential bounce back are energy prices and housing prices. So energy, we do a lot of work on that. We think that we're kind of stuck in this 75, 95 range. And also in the fall, it should weaken up. So we're not worried about energy. And also it's important in the US, we have natural gas that trades at the equivalent of about $18 a barrel. So it's highly deflationary here, not true of the rest of the world. Rest of the world, natural gas trades roughly BTU-wise the same as oil. So we're not concerned about that. And I think the chances of housing prices taking off like a rocket when mortgage rates are 7.5% is close to zero. So we're not concerned about a re-acceleration. And then we know that the current measurements for CPI and PCE are flawed because of their shelter component. And also, we don't like PCE because it has 20% medical. But I would say we don't stick this on our website, but we calculate PCE-R, so that corrects for shelter, and that's only at 2.6% right now.
And well, CPIR is only 1% year over year, right?
Correct, yes. So we think inflation's already behind, that problem behind us, and no signs, you know, again, looking at the forward indicators, because we were massively concerned about inflation early 21. So we think that's behind us. Whether the Fed raises one more time or not, we don't think is that critical, but we do think that global tight monetary policy is an issue, and I think that's what is driving long-term rates up right now.
So, all right, let's get then to Europe. What's the inflation picture look like to you over there? If it's subdued here, but you mentioned we have deflationary natural gas prices, and of course they don't. How does inflation look to you on the continent?
Well, I think that is a real problem because they've had an enormous increase over the last 2 years, and they're less competitive. But our biggest concern is that global monetary base, and we will publish this on our website as well, although you can get the data. You can just, if you can add, you can get it on the terminal as well. But it's still good to publish it because even I haven't focused on it enough. Dropped by $700 billion in the last 2 months, which is an enormous drop. That's a 3%.
What dropped by 700?
The global monetary base.
Okay.
So the global central bank sucked out $700 billion of capital.
And we've seen M2 fall here as well.
Right, yeah. So those are a little bit more lag. But if you look at I would suggest look at the monetary base because that's the leading indicator because it's the major component. And I would also say don't ignore this. So I made a good call to at least our clients. When the Fed intervened, I said, okay, that's a sign. Back in the pandemic, they're adding, you know, 1.2 trillion of capital to the capital market every year. That's just enormous. That's like Warren Buffett, you know, putting his 100 billion to work 10 times. So I wouldn't ignore the monetary base and those radical changes in particular. So if they're small, you can ignore them. So we think that's the key driver behind this big rise in rates. And we did that work because really, frankly, our call was they were going to drop and it was dead wrong. So we said, well, how can this be? And that's when we discovered, because we should have been tracking it as well more closely, that the ECB has just done this massive QT, and that affects all rates in the world. If you look at it, our bond is 85% correlated with all the benchmark bonds. So coming up with an explanation just focused on the U.S. is not going to be correct when you're talking about the world bond market.
So what happens to interest rates? When can I refinance my mortgage at a lower rate?
Paul is single-minded and focused on the high mortgage rate that he got. It's adjustable, though, because he was figuring at the time, well, next year I'll be able to refinance at a lower rate.
Yes, so I have adjustable rate mortgages as well, so I'm very focused on this. But I don't think that we're going to get any relief till probably mid next year because the Fed's about a year behind what they should be doing. So they should have cut when the banking crisis started. And that is another reason why they should pause, and I think that maybe even they'll figure this out, is that the banking system is under pressure, being downgraded. They were downgraded this morning. They should be focused on that. So I think we'll get relief next year. But the thing to watch, and the reason that we're sticking with our bullish call on interest rates, is that we do think that the European economy is going to crack. They have mostly floating rate mortgages, way more than they do in the United States. They have this natural gas problem. Germany is levered to China, and their ECB is a single mandate central bank. So they're going to continue to tighten really probably till their economies crack. So I think that's when rates will come down, long rates will come down, when it becomes more obvious that Europe is headed into a recession, which is our call that they're almost certainly going to probably even a substantial
Despite
recession.
all the Americans over there traveling?
Yeah, that, at the margin, that does help.
Okay.
Yeah, the U.S. definitely does prop up the rest of the world, but still, when you think about all those factors are negative, then what is the bull case for Europe?
So how about China, just because we've been talking a lot over the last several weeks, reporting on the weaker than expected economic data out of China. How do you kind of view all that?
Well, with regard to oil, which is what we mostly focus on China about, is that the thing to keep in mind is that, of course, reporters have to write stories. So why is oil down? We talked to them about this. Oh, it's because of China. Well, that's usually not the case. They have very slow growth in oil demand that's very sticky. So we don't think that that demand's going to drop. But we also think that could be positive for long-term rates because the Chinese central bank is definitely going to cut rates. There's a disappointment when they cut last time, but they're going to continue to cut rates. They've really hammered their economy through regulation. It's a good example why maybe capitalism is superior to communism. And so when you do that, it hurts economic growth. And so they're going to offset it with monetary policy, and that should also be bullish for long-term rates.
And I'm just reading your notes here real quick, 30 seconds. Fourth quarter for the stock market, S&P, range of 4,500 to 5,000.
Correct. Although I would say that that's dependent on rates at least stop rising, as fast as they have been over the last month or so.
Okay. And anything added, Jackson Hole?
We think it's going to be a non-event because the Fed's already signaled what they want to do. They have the dot plot, and we know there's a dovish camp so that we won't get a repeat of last year where Powell comes out and kind of talks the market down.
Right. Interesting. All right, Jay.
So you don't think there'll be a hawkish bent?
Little bit, but not anything significant like it was last
Nothing
year.
to write home about.
All right. But let's send the team out there anyway.
Yeah,
why not?
two teams.
Yeah, sure.
Yeah.
Jay Hatfield, CEO, founder, and portfolio manager, does it all. Infrastructure capital management, one of the smarter discussions Matt and I have as we try to think about these markets and navigate through these
And I like
markets.
his website, Infracap. Infracapfunds.com.
Boom, there you go. Go check it out. Right now, let's head down to Washington, D.C., world and national news with Amy Mars.
All right, thank you, Paul. Trump attorney John Eastman, who pushed that plan to keep Donald Trump in power, has turned himself in to authorities in Georgia. Eastman has been booked at the Fulton County Jail. He's also been released. He's charged alongside Trump and 17 others. Trump himself says he'll turn himself in on Thursday. A new poll shows more than half of voters likely to attend Iowa's Republican caucuses believe Trump's false claims that he won the 2020 election. The survey by NBC News and the Des Moines Register found 51% of respondents believe Trump, 41 don't, and 8 say they just don't know. More cities are making room for asylum seekers as the debate over busing migrants heats up. Reverend Cindy Jacobson in Massachusetts says churches are now collecting baby formula, diapers, and some cash donations.
The response was overwhelming. And coincidentally, our lessons on Sunday had to do with welcoming the foreigner in our midst. It was perfect.
And state workers are turning a hotel in Woburn, Massachusetts into an emergency shelter for migrants. A federal judge in Texas hearing arguments over the so-called floating border wall. Critics say the string of buoys meant to discourage illegal immigration is nothing more than a political stunt. Democratic Congressman Henry Cuellar of Texas says the state will eventually have to take it all down.
It's a federal responsibility. The Supreme Court has already said when they took up the case in Arizona that it's a federal responsibility.
Texas moved those buoys closer to shore to address concerns that they're floating in international waters. A heat wave sweeping the Midwest is threatening to dry out grain crops in the final few weeks of this growing season, putting a bumper U.S. harvest at risk. Temperatures are forecast to reach as high as 115 degrees in parts of the Midwest this week. The global food supply is increasingly dependent on the U.S. harvest. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
Television. Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major averages right now, they have turned mixed, a little change. In the S&P 500, you have the financials. Right now, they're the biggest drag after the S&P, that is, joined Moody's Investor Service in cutting some lenders in the U.S. And on the eve of its quarterly report, you have NVIDIA shares. They've been bouncing right now down close to 2%. So where should investors put money to work? Jill Carey Hall at Bank of America Securities is looking at consumer discretionary stocks.
If we are moving into more of a recovery environment, if the Fed is done hiking soon, that's usually when the consumer discretionary sector tends to start to work.
Traders also watching the catalyst later in the week. That's when the Federal Reserve Chair Jerome Powell is scheduled to deliver the speech in Jackson Hole. Now, at least according to the MLive Pulse survey, Powell's commentary widely expected to be hawkish. Right now, the S&P 500, I'll call it unchanged, 43.98 on the index. The Dow Jones Industrial Average, 99 points lower. That's down 0.3%. The NASDAQ 100 in the green, that's up 24 points. That's up about 0.2%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney here in our
He was
Bloomberg
out getting food.
Interactive Broker Studio. Yep. No, there's no food in the studio.
I was getting
water.
water.
Do such a thing.
Oh,
Yeah,
well, you
It's
know,
only
that's
water,
more
Anthony.
dangerous because you could potentially pour it on the electronics accidentally.
Well, he's got the lid on the cup. I think he's in pretty good shape. I'll vouch for him. Let's get right to our next guest, Brian Crawwez, president of Sharp Investments. And this guy is all in at Berkeley. He gets his undergrad from Berkeley, then his MBA from the Haas School at Berkeley. Unfortunately, the Cal Bears do not have a conference. Where are you guys going, Brian?
The rumor is that there might be a meeting today on the ACC, so we'll see. I think flying across the country is going to be a little unique experience, but yeah, the Pac-12 is down to the Pac-4, so we're crossing our fingers we'll land
It's
somewhere.
unbelievable what happened. Anyway, I'm a Duke guy, so I would welcome you and Stanford. Be a great addition, and but yeah, it's crazy. I mean, you can fly the the women's field hockey team across the country. Where's the revenue to support that? I have no idea how that all works. But Brian,
it's crazy. Yeah, we're crossing our fingers. I was just on campus yesterday. They're optimistic. We're going to find a home soon. So
all right. Yep. Love to have the Cal Bears. As long as you guys continue to play Stanford every year, that's kind of all we care about. Brian, what are we doing with this market here? I don't think I was really fully invested in the Magnificent Seven stocks that just ripped so far year to date. So I'm kind of left with so performance. I got yields pushing higher. What's your call here on this market?
I mean, what's interesting, we took a look back over the last 30 years, and if you look at the average stock within the S&P 500, so the S&P 500 is 500 companies. Obviously, it's market cap weighted, so the return of the S&P 500 index is not the same as the average stock. The average stock actually outperforms by about 0.3% per year on average over the past 30 plus years. And that makes sense because you got smaller companies in there. Smaller companies tend to grow faster. So you get a little bit of a return premium for owning the average stock. This year, though, is the worst since 1999. The average stock's outperforming,
I remember what happened there.
The S&P 500 by about 11%. So we think there's a lot of opportunities within the average stock, but we'd be careful of kind of those Magnificent Seven and kind of the index more broadly. What's interesting is if you look at the next 5 years after 1999, the average stock went on to outperform by about 8.5% per year over the index. So we think it's a good time now for investors to be looking outside of the sort of common theme of investment that you're hearing from most people.
So you're basically saying active beats passive in the future, I guess midterm future.
We would think so, yeah. If you're not sort of concentrated in those big names, everyone's holding their breath for NVIDIA, for example. But while NVIDIA is a great company, the expectations built into NVIDIA are substantial. So you need to see really great growth over the next 5 years to justify the price. Where there's a lot of stocks that are trading at much lower multiples with much lower expectations that'll probably outperform in the end.
All right, so what are some of the individual stocks that you like, if not the big Magnificent Seven?
Yeah, I mean, you talk about AI, right? And you think about all the need for all the internet and broadband and stuff, and sitting in plain sight is a company like Comcast. Comcast is trading at under 10 times. People think of it as a cable company, cable TV. They're all worried about cable cutting of cable. And in fact, it's really the broadband that's driving the business. Broadband continuing to hold up. They're actually growing their wireless subs, pretty nicely. And so we see Comcast continuing to grow earnings at double digits, and sitting here trading at 10 times earnings.
That's interesting because it's a name I know well, and I'm just wondering. We've got, as you mentioned, cord cutting, so that they haven't led with their cable business for a long time. They've been leading with their broadband business, but they're facing a lot of competition in the broadband space. Is that still a growth driver there for Comcast and some of the other cable companies?
Yeah, there's some of the wireless companies now have, kind of fixed wireless, and in some markets that makes sense, but it still doesn't have the broadband capacity of your core cable broadband. In addition, you guys have reported on this lead cable issue, which a lot of the telcos have. That's going to be an additional cost for them, which will make it harder for them to continue to build out fiber and actually compete with the cable companies. We just think that the cable companies, both Charter and Comcast, have a core advantage over the wireless competitors, and so ultimately we think they'll continue to be able to grow profits in the broadband side.
By the way, I'm just looking at a breaking headline here. Marks and Spencers and Diploma are two companies that are going to join the FTSE 100 index. What do you think about international investing? Do you solely focus on the U.S.?
No, we do international. We have global fund. We do international investing. If you look at, I think most commentators would tell you that international stocks are a lot cheaper than U.S. stocks. And outside the U.S., we are finding names. In fact, Baidu is a name we own that they reported today. 15% sales growth, beat on revenue, beat on earnings. Trading at under 15 times calendar 2025, has a leadership position in autonomous driving in China. Also has their Ernie bot, which is going to come out and compete with ChatGPT. But yet it's trading at a low multiple because it's in China as opposed to being in the U.S.
But that makes sense, right? I mean, you never know what they're going to do. They could decide to regulate that company out of existence if they wanted to.
It's certainly possible. Certainly that is a risk that investors have to consider. I would point out, though, when you look at the big indexes, there's Tesla, Apple. Those are companies that are fairly dependent on China growth for their long-term growth outlook, and they're having very, very high multiples. So there's a little bit of a bifurcation in our mind in terms of how investors, if it's direct in China, investors don't want to touch it at all. But if it's a U.S. company with China exposure, investors seem to not be that worried about it right now.
You've got a name on your list which I didn't even know was public, but it's a name everybody knows, U-Haul. Talk to us about that company and that stock.
So U-Haul is one of those companies that we love. It's a company that everyone knows, great brand name, a dominant position, really hard to compete with, and yet the stock is under the radar. It's not big in indexes. There's the founding family owns 50% of the voting shares, so liquidity is lower than a lot of stocks, and it's not widely held in the indexes as a result of float being lower. But to give you a quick snapshot on the truck business, they've developed all of these independent networks as well as company-owned stores, and so you really can't compete with them. There's nobody with anywhere near the size and scale of their network. And on top of that, we've talked to the company, and to build out a truck-only facility now is basically uneconomic, given how cheap they can rent these trucks for. What a lot of people don't realize is they also have 82 million square feet of self-storage. And there was a couple of deals recently. Public Storage bought there was a Life Storage deal. And if you look at the price of that, it was about $200 a
Interesting. Okay. Hey, Brian, you're going to have to leave it there just in case of time. Brian Crow is president of Scharf Investments. We're going to have more coming up. This is Bloomberg. get some company news right now with Lisa Mateo.
You got it. Shares of Dick's Sporting Goods are falling right now. They are down about 23%. And this after the company cut its profit outlook for the full year. Now, the retailer has been dealing with slowing growth and more theft at its stores, and it's now making some staffing adjustments. Bloomberg's Gina Cervetti has that story.
Now the retailer has laid off about 250 employees in the corporate offices. A source tells Bloomberg that retail workers were not affected by the cuts, and some of the savings from the layoffs will be used to hire workers in other areas.
Now, cutbacks are hitting a major brokerage as well. Bloomberg's Scott Carr has that report.
Charles Schwab is planning to cut at least $500 million from its staff, its professional services, and real estate costs. It appears to be the latest step by the brokerage to respond to pressure from investors as it continues to integrate TD Ameritrade into its business. Charles Schwab acquired TD Ameritrade in 2019.
Now, shares of Charles Schwab by now down about 4%. And Walgreens has agreed to pay $16 million to settle a whistleblower's False Claims Act suit, alleging overcharging for generic drugs. Whistleblower Jay Douglas Strouser had claimed that USA Drug, which is a regional pharmacy acquired by Walgreens, overbilled Medicare and Medicaid millions of dollars by charging more for generic drugs than the regular prices that are paid by those without prescription drug insurance. Strouser will receive 29% of the federal government's recovery. Right now, checking in with shares of Walgreens, they are down just a fraction. Those are the company's stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio in New York City. Bloomberg World HQ, 59th and Lexington Avenue. The S&P pretty much unchanged on the day. Dow Jones off 0.3. NASDAQ up about 0.1%. 2-year Treasury spot on 5% right there. The 10-year Treasury off about 2 basis points, 4.32%. WTI crude oil, it is absolutely steady, $80.73. So we've got some oil, definitely higher than what it was. And we're going to talk about gasoline because that is a lot higher, and that's got my attention as you drive around here towards the end of summer. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
All right, thank you, Paul. Trump attorney John Eastman has turned himself into the Fulton County Jail as part of the 2020 election interference case in Georgia. He was booked and then released. He agreed to a $100,000 bond yesterday. Eastman is one of 18 people charged in a sweeping racketeering and conspiracy case, including former President Donald Trump. Trump says he'll turn himself in on Thursday. All 18 have until noon on Friday to surrender to authorities. New York Congressman George Santos is calling for the border to be closed while protesting an asylum seeker shelter in Queens. This was earlier this morning.
We have homeless people through the wazoo in this country. Homelessness is a crisis in America, and yet we're taking in more people and diverting resources and diluting resources away from Americans.
Santos is calling on New York City and federal officials to put migrants in Democratic districts where he says people voted for policies that led to the crisis. Tropical storm Harold is crashing into the Texas coastline, bringing some much-needed rain to Brownsville. Cameron County Judge Eddie Trevino says they're expecting about 3 inches.
Just like the entire country, we're in dire need of water. So hopefully it won't all come at once.
Judge Trevino says there is no flooding, not yet. The Biden administration will start accepting applications today for a new income-driven repayment plan, a fresh effort to shore up student loan borrowers facing a cliff as the pandemic-era benefits end. The so-called Saving on a Valuable Education, or SAVE plan, is meant to disproportionately focus on low-income borrowers, calculating payments based on income and family size, not so much your loan balance. Officials said borrowers' monthly payments could be reduced to nothing. Others should save about $1,000 a year. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Amy Morris, and this is Bloomberg. Matt and Paul.
All right, Amy Marsh, thank you so much. We appreciate it. Matt, we're just calling out WTI crude oil at $80.73 a barrel. Gasoline prices. Regular gasoline now stands at an average of $3.85 a gallon. That's just 5 cents below last year, but it's the second highest seasonal level in records going back to 2008. We need more refineries, dude. That's my call.
Yeah, I mean, it does seem like that when you look at the gap between the pump price and what you're paying for a barrel of oil. We did have, though, low inventories. That was one of the problems. And, of course, refinery operations are hurt by
hurricanes.
Record heat.
Record heat, right. Okay, yep.
So that's, this is the kind of thing that, who was talking to us about this yesterday? Claudia Sahm was saying that heat is problematic, and she's written a Bloomberg opinion piece about it as well for the U.S. economy. Add the hurricanes or the storms that we see to that as well.
Yeah.
And it's a real problem. We need more refining capacity and probably in different places than it currently is, which is going to mean more pipelines.
Right. And that, A, almost impossible to build a refinery. B, same thing goes for a pipeline.
Yep.
So you got the Caribou and all that kind of stuff. But I don't know. It just seems like, the whole thing just seems, a little bit risky, particularly when you think about what's happening over in Europe, with, no longer really having access to Russian fuel. And I'm not sure when that changes, if ever. So
I mean, they have access to it, right? They just have to do this silly thing where they pretend they don't buy it, so the Indians buy it, and then the Indians refine it, and then they sell the refined product to the Europeans.
That's right. So that's how it works. So we'll keep an eye on that. Again, regular gasoline, $3.85 a gallon across the U.S. A little bit cheaper down at the Jersey Shore, but not much. And people still got some driving to do this summer, so paying attention to the price at the pump. We're going to have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to talk about the regional banks here. Herman Chan and Arnold Kokuda, they're both from Bloomberg Intelligence, so they're smart folks. S&P just downgraded the banks. I guess it's better late than never, but we'll check in with the smart folks who do this stuff for a living. Jennifer Rhee, she's a senior antitrust litigation analyst. Microsoft, Activision, is this deal getting done?
Looks like it's going to happen.
I think so. Looks like the UK folks are going to re-look at this thing. And then we're going to talk about private credit, one of our favorite areas, one of the really fast-growing areas within Wall Street. Jackie Ward, Director of Private Investments at UMB Bank, will join us to talk about the private credit business. But first, let's kick things off with Charlie Pellet.
Hi, thank you very much. And here's what's going on. The Dow, the S&P lower, NASDAQ higher. Do want to begin with the headline right now on the Bloomberg Professional Service X. J.P. Morgan gold trader Greg Smith gets 2 years for spoofing. The headline right now on the Bloomberg Professional Service. Stocks, for the most part, trading lower. We have got stocks struggling to find solid footing after a technical rally in big tech. Traders bracing for NVIDIA's results tomorrow, which are set to test Wall Street's fervor around the artificial intelligence hype. We have got the S&P now lower by 6, down 0.1%. The Dow down 132, drop there of 0.4%. NASDAQ, though, in the green, up 32, up by about 0.2%. 10-year yield at 4.32% with the 2-year, 5.01% right now on the 2-year. Spot gold up $3.50 the ounce to $18.98, up by about 0.2%. And West Texas Intermediate crude, just talking about refineries, little changed, up 1 cent right now, 80.73 for a barrel of WTI. So we've got NVIDIA tomorrow, but has the stock gotten ahead of itself in the run-up to earnings? Ashwin Alankar is Global Head of Allocation and Risk Management at Janus Henderson, and he was a guest right here on Bloomberg Markets.
Right now, the rage, and there could be a bit of over-exuberance here, is in the catalyst of artificial intelligence. And you're seeing names like NVIDIA, names like Microsoft, names like Oracle, Google, really, reaching new highs. And that might be putting the cart a bit ahead of the horse.
And again, NVIDIA shares trading down by 2.6%. He mentioned Microsoft up 0.6%, Oracle down 0.3%, and Alphabet right now higher by 1.3%. So it is a mixed Tuesday here. The Dow, the S&P, they are both lower. NASDAQ is advancing up 38 points right now for the NASDAQ Composite Index. S&P down 5, a drop there of 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, coming to you live from the Bloomberg Interactive Broker Studio. We are also streaming live on YouTube, so just head over to youtube.com and search Bloomberg Radio. Let's take a look at what's happening under the hood with these equity markets today. We can do that with Bloomberg Equities reporter Nora Melinda. Nora, what are you looking at today?
So the market is definitely in a different place than it was a couple hours ago when I joined you both. But looking at some banking stocks, we're seeing banking stocks underperforming the broader market this morning as we're moving into the afternoon. And that's after S&P Global Ratings joined Moody's in downgrading a handful of lenders. KeyCorp is down. That's one of the ones that it lowered by a notch. Commercia, Valley National Bank Corp, UMB Financial Corp, and Associated Bank Corp. KeyCorp and Commercia have been some of the worst performing stocks this year in the banking index. So those are some interesting moves happening this afternoon.
And was this just the macro stuff that we kind of know about?
Yeah, it's really just the impact of higher rates and deposit moves across the industry. That's mainly what the S&P is citing.
We're going to talk to Herman Chan about that.
Yeah, we're going to have Herman Chan and Arnold Kokuda from Bloomberg Intelligence coming up in just a moment, so we'll break it all down.
Definitely.
And financials are the worst performing industry group on the S&P 500 right now. One of the big gainers is real estate. Another one is consumer discretionary. I guess the housing data that I mean, looked bad, right? Existing home sales were less than we anticipated, but that's good for new home builders.
Definitely. It will make them really perform well. I mean, of course, home builders are building off of the fact that they don't have as much competition, and it allows them the opportunity to take market share from existing homes. So they really have an open runway to really rally and continue to build, and especially since there is still demand for people who are looking for housing. There's a lot of places where, there's limited housing inventory, and so they're able to up prices. Some of them are even pulling back on the incentives that they used to have as demand remains high.
Yeah, stocks have been. We had Drew Redding on from Bloomberg Intelligence earlier, who covers the home builders, and the stocks have done great. The backlogs, remain pretty strong here, and they are trying to, entice some first-time buyers with buying down some of that mortgage, maybe taking your 7.5% in the marketplace right now for a 30-year, and maybe offering you 5.5%. So that kind of incentive. How about some of the retailers? They continue to kind of report some results today.
Yeah, so over in the retail space, I'm looking at Dick's Sporting Goods. That stock's declined more than 25% today for its biggest intraday drop since 3 years ago, back in March 2020. Essentially, the company missed its sales and profit for the second quarter, and it cut its profit forecast for the full year. A lot of that is due to shrink, which is an industry term that focuses more so on the theft and the employee theft, damaged goods.
So it really is materially higher than average, right?
Yes.
Okay, because I see the videos on social media, and I don't know if that's just, here or there, but it's really just a
sensationalism.
Yeah, but it's a real thing.
Right, everyone's...
We hear from multiple retailers.
Definitely, and we are seeing more of an uptick of that happening in the past year. So,
what do they call that? Inventory slippage or something? Shrinkage.
Shrinkage.
That's right. Not like George Costanza, but
not like George.
Although it is at Dick's. Looking at them over a 5-year period, they still have done relatively well. I mean, Dick's is up 250% over a 5-year period.
Nice.
Even with today's drop.
Wow.
That's insane, right?
Well, that's a pandemic stock, don't you think? I mean, more people going out and buying stuff.
It did really do. I mean, it got hit hard, obviously, at the beginning of the pandemic, and it had come down substantially, but it did rise a lot. And I've noticed in a lot of malls around the country, you had previously Dick's with other competitors, like REI, for example, in the Ridge Hill Mall in Westchester, New York. And REI's out of there.
Okay.
Dick's is the last man standing.
REI is a standalone store.
Yeah, no, I mean, they were next to each other is my point.
Oh, I see what you're saying.
You had REI, you had LLB, and you had Dick's, and now it's just Dick's.
Okay.
Wow.
All right, interesting. And NVIDIA's after the close tomorrow, right?
Definitely, all eyes are on NVIDIA. It's really been moving the market as investors are really anticipating their earnings tomorrow. Stock was up at the open, but now it's down almost 2% after hitting that earlier record intraday high. Tomorrow will really be a testament as to whether or not the AI hype may last.
I'm going to pay attention to that. That's for sure. Nora, Melinda?
It's tomorrow after the bell.
Yes.
Yes.
So, but when you say you're going to pay attention, does that mean you're going to turn on the TV or turn on Bloomberg Radio on Wednesday night, or are you just going to read in early on Thursday morning?
I'm going to have my phone at 4 o'clock to see the print, and then I may even listen to the conference call.
Set a timer.
Yeah. Wow.
Because I think this is going to really... It has moved the market this year. Since they reported the quarter,
for sure.
And I think it's going to have it could have an impact.
And the CEO is kind of a superstar. He's a big leather jacket guy.
Yeah, I didn't know him until this kind of burst onto the scene. All right, Nora, thanks so much for joining us. Nora Melinda covers all of the equities for Bloomberg News. All right, let's get this banking thing. We got S&P coming in, better late than never, I guess, kind of saying, hey, there's challenges for the regional banking sector, and they take down some names here. Let's break it down with our experts. That would be Herman Chan, and that would be Arnold Kokuda. Herman joins us live here in our Bloomberg Interactive Broker Studio. Arnold Kokuda making use of the Zoom functionality out there. He joins us as well. Arnold, let's start with you on the credit side. Where do you see kind of the pressure that we're seeing across the regional bank space in the credit side?
Yes, I think some of these actions by Moody's and S&P, I think just gives us a reminder that this, now I guess I wouldn't call it a crisis anymore, but, these issues still exist where there is pressure on these banks and their balance sheets, right? Funding costs are rising, deposits have fled, yes. So I think a lot of these things that the rating agencies are coming out with now are, it is backward looking, but it is a reflection that, all things aren't all fine and dandy in regional bank land.
So if I wanted to go out, I'm a regional bank, a reasonable credit quality, can I go out there and raise capital in your credit markets? And if so, like, am I going to really have to pay through the nose?
Well, I mean, the before March, regional bank debt, it was, we're in a totally different world. It used to be they trade really tight and you couldn't get enough of it, right? And it trade tight for the credit rating. Now we're in this opposite world of, it trades wider. I mean, things have, gotten better, obviously, since the heydays of March and May. But, compared to before, spreads are wider. And a lot of these will be hit with new debt requirements. So we expect debt issuance to pick up for a lot of these. And we have seen a couple of regional banks tap the market. We have Charles Schwab today. And then we had, Huntington and PNC come, in the past week or so. So it is available. If the debt does come, with some, a little bit meat on the bone, let's put it, then there will be demand.
Herman, what do you think about the banks that were specifically downgraded by S&P? You've got KeyCorp, Comerica, Valley National, UMB, and Associated Bancorp.
Right. So I would say that the issues that the rating agencies have highlighted, a couple of them, KeyCorp, Comerica, they're facing some weaker net interest margins than some others that in our peer group. That's really driven by some higher deposit costs. They actually, these two banks in particular, have mishedged their balance sheet a bit, where they were expecting interest rates to decline potentially next year, and it seems like we're in a higher for longer environment. So that's actually crimping their margins a bit more than some others.
Is the deposit flight the kind of thing that's still ongoing? I was actually at a cocktail party.
Shocking.
I think like 3 or 4 weeks ago.
Okay.
With a group of ladies talking about how they got high interest rates in this one bank account, and I saw one woman just over the course of a conversation at like 6 p.m. on a Saturday say, you know what, I'm just going to move like $100,000 from my savings account and my bank that I've always used into this. I can't remember if it was the Goldman Sachs account or some other, but 4.5% yielding savings account, and just boom, done.
Right. So what we've seen since the fallout in March and April is that the deposit balances have actually stabilized across the industry, and how that's happened is they're just paying up for those deposits. So you're seeing high interest savings accounts, high yield savings accounts, approaching 5, even above 5%, CDs above 5% for a 1 year term, 15-month term. So that's really the gist of it. The banks are paying up, and that's really crimping net interest margins and pressuring profitability going forward.
Arnold, are you seeing any investors come in your market and saying, boy, I see some real value here in some of these bonds?
Well, I mean, I think, definitely for, in a market, let's say until from May to August, right? It was a classic risk on, treasury yields higher, spreads tightening. And in a world where everything seemed to be pricing to perfection, one of the things that were still cheap is kind of the regional banks, right? And given what they went through. So yeah, I think there is a lot of demand for regionals, but I think at the right price, right? And if you look at credit spreads now, where they are, tighter. If you would have woken up today versus not knowing what happened from all of this year, you wouldn't even know that there was a banking crisis this year, right? Given how things have recovered. So I think at the right price, there'll be demand, but things have we've had a bit of a kind of everything sell off in August, right? That's coincided with these rating downgrades, rate negative outlook cuts. But I think things had been pricing a little bit for perfection. But I think if these new issues come to market with a little bit of meat on the bone, then I think you'll see investors step up and go for it.
The stocks haven't really recovered, Herman. If I look at KRE, for example, which is the regional Spider S&P regional banking ETF, it's still at the same levels that it hit after the big problems that we had, the drop that we saw in March.
Right. The stocks have rebounded a bit from the lows back in April and May, but still well below pre-SVB fallout. So,
I mean, the KRE dropped to 44.5 on March 13th, and right now it's trading at 43.60.
Right. Valuations are really reflecting the tough environment that Moody's and S&P have articulated. So, tougher profitability, weaker lending, regulatory requirements are going to increase, and we still haven't really seen the shoe to drop on the asset quality side, in particular office commercial real estate, quite yet. So there's going to be a lot of headwinds, and the banks will just need to navigate that, and any upside really is going to be dependent on where interest rates go and potential cuts down the road.
So Herman, what do we know about the regulatory changes coming along?
Mm-hmm. So the regulators and the Fed have put out a 1,000-page document that outlines some changes to the regulatory requirements for particularly the largest banks and the largest regional banks of $100 billion and above. That's really focused on tightening how capital ratios are calculated, including unrealized losses in the securities portfolio, in the AFS securities portfolio, into capital calculations, increasing the debt stack, as Arnold mentioned a bit earlier. But there's still going to be some other areas that the regulators are focused on. I recall during the SVB crisis that uninsured deposits was a big thing. So the FDIC is looking at that, and then the Fed's also going to come out with some regulatory issues on liquidity as well. So there's still more down the road, and so the banks will just need to have to manage through it.
All right, guys, really appreciate getting the update there. Again, S&P following Moody's and downgrading some of those regional banks. Really nothing new in kind of what they're doing, but simply kind of reflecting kind of what I believe the market's known for some time. Herman Chan, Arnold Kokuda, they cover the regional banks, all the banks on the regional side for Bloomberg Intelligence, Arnold on the credit side, Herman on the equity side. So we got you all covered there on the regional bank space. S&P 500 off about 0.3%, so a little bit weaker. Dow off 0.5%. The NASDAQ kind of hanging in there, kind of flattish on the day. No real change there. DXY index, that's higher today, so the dollar a little bit stronger. 2-year Treasury yield, 5%. How about that? This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Labor deal that was reached with its pilots yesterday will not hurt its outlook for the year. The $9.6 billion pact is the most expensive labor contract ever for a U.S. carrier. Bloomberg's Mary Schlen-Jenstein spoke with Bloomberg Surveillance.
Well, American had been accruing for the cost of the contract. They did put out a statement this morning saying that it's going to boost their unit costs because there's an extra amount that was agreed to when they renegotiated this tentative agreement that they had. So that's going to increase their unit cost about 2 percentage points this quarter. But for the full year, it's not boosting their unit cost. So they're really in fairly good shape.
Now, that new package would provide 46% in cumulative pay raises and retirement contributions over its 4-year term. Shares of American Airlines right now down nearly 2%. As climate change brings on more natural disasters, the cost of insuring against them keeps going up. Bloomberg's Tom Metcalf has the numbers.
2023, unfortunately, is going to be another year where this $100 billion threshold of insured losses from natural catastrophes is going to be breached. So last year, I think it was about $125 billion in 2022 already so far, just in the first half. 2 reinsurers, Munich Re and Swiss Re, have shown $93 billion of losses.
Now, Metcalf says about more than 2/3 of this year's losses are just from severe thunderstorms in the U.S., and the Atlantic hurricane season isn't even over just yet. Those are the company stories we're following this hour. We'll have more Bloomberg Markets in just a bit. I'm Lisa Mateo. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Lows of the day right now on the S&P 500 index. We are looking at a 12-point drop for the S&P. Stocks are retreating, down now by about 0.3%. Dow Industrials down 166 points, a decline there of 0.5%, while NASDAQ is down 3 points, little change, down less than 0.1%. 10-year yield at 4.31% with a 2-year now yielding 5.01% on the 2-year. Spot gold up almost $3 the ounce to $18.97. That's a gain of about 0.2%, while West Texas Intermediate crude is up 0.3%, $80.97 a barrel on WTI. Investors are awaiting the latest earnings report out of NVIDIA tomorrow. That stock down right now by 3.2%. IBM is going to be selling its weather business to Francisco Partners, which will operate it as a standalone company. IBM's consumer-facing weather services such as Weather.com and business-oriented offerings will be acquired by the tech-focused private equity firm for an undisclosed sum. IBM shares down now by 0.3%. Again, recapping, the S&P lower by 12, down 0.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. Let's talk Microsoft. It would like to buy Activision. In fact, so much so that it's got a $69 billion transaction on the table. Needs regulatory approval, and the UK was really a sticking point, but maybe they're rethinking their strategy here. Maybe this deal gets done. So let's go to Jen Rhee. She's a senior litigation analyst. She's covering all the antitrust stuff for Bloomberg Intelligence. She joins us here in our Bloomberg Interactive Broker Studio. So, Jen, it looks like the UK is taking a little bit of an about face and may take a fresh look at this deal.
Yeah, that looks like what's happening. As a matter of fact, they've been looking at it again for about a month. And I think Microsoft actually tried to push this through on a second look without doing what it's done now, which is made some concessions to transfer some games to Ubisoft. And that didn't really work. We thought maybe there'd be a final report by August 29th by the UK. Now it's been pushed to October because the deal's been restructured and they have to take a look at the new concession. But it's looking pretty good for Microsoft. You know, they've been talking to the UK. They know where they are. There's been open communication, and I really doubt they'd be moving forward with this unless they thought that they were going to get clearance at the end of this road.
Yeah, just looking at the stock of Ubisoft, which trades on French exchange, up 8.5% today.
So are those concessions going to be what the UK wanted to see? Isn't it all about Call of Duty? I mean, does anything else matter?
I mean, really, this was about Call of Duty, but the UK has made it beyond, they don't know what's coming out from Activision. These are content creators, right? And maybe it'll be the Activision that creates the next Call of Duty or, the next really popular game. So they were really just concerned more about the future because they think the future will be more of what they call these AAA games, and also the future will be streaming games through the cloud rather than downloading them to hardware. So that's what they're trying to protect, and that's what they've done by requiring or Microsoft agreeing that they will transfer all of the Activision games, including Call of Duty, for the next 15 years to Ubisoft. So Ubisoft can then license those games to be streamed through the cloud.
Where do we stand in the U.S.?
Yeah, well, the U.S., it's been really quiet and you don't see much in the news. There's still an appeal. The FTC is still fighting this deal. In the U.S., they lost in court, and then they lost their attempt to get an emergency stay after they lost their attempt to block the deal. They do have an appeal pending. The briefing's going to be done in September. You could probably have oral argument maybe by the end of this year. I mean, if this deal gets UK a clearance in October and the deal closes, it means the FTC's appeal will be ongoing after the deal's already consummated and integrated.
So does that typically happen? There's still going to be a review of a deal that's closed?
It can happen, and the FTC has done that. I'm a little surprised by it. After they lost in the district court and then lost their effort to get an emergency stay, I didn't really think they'd continue to pursue this appeal because they lost pretty soundly in court. I mean, the judge really said you just don't really have any evidence to prove out your theories of harm in this case. And I don't see this, I see it as a losing battle. And I'm a little bit surprised that they're continuing on that road. They may still withdraw it after this agreement with the UK. That might give them the ammunition they need to say, okay, things are different now.
Is it political so the Biden can go on the campaign trail and say, I'm tough on business?
Of course it's political. It's always political.
I'm trying to ask a nice middle-of-the-road question.
You know, antitrust decisions on mergers are not supposed to be political. And really, honestly, in the past, they mostly were not. I would say now it has moved into the political realm for sure.
Yep.
I mean, you have a political viewpoint right now that we've allowed too much consolidation in the market and we need to stop it. We need to slow down M&A activity in many industries. And that's why we're seeing these aggressive actions by the FTC and DOJ. And that is political.
All right, so what else do we have out there? So it looks like this deal's moving forward. What else is in your...
Hang on, let me just get quickly...
Sure.
So if the FTC and Con, I mean, clearly they're going to appeal and appeal and appeal, but at some point that's over. And if the UK approves this, who else has to give it their blessing? I mean, is there an EU regulator that they need? Is there a Chinese regulator that they need? Is there a Asian or African regulator that they need? Does Australia want to block the deal? I mean...
they have everybody else they need, and it's really telling because almost all of these jurisdictions, and some of which are very serious when it comes to antitrust, like Brazil, cleared this deal without concessions. Now, the EU is saying, look, this is a new deal. It's been restructured, and we reached a settlement with Microsoft, and we need to make sure this doesn't impact our settlement, so we may have to take another look. I don't think that's going to be a hindrance to getting the deal closed by the deal's end date in October, though.
And just refresh our memory, the UK gets a look at this deal because of Brexit. So they no longer abide by the EU review of the deal.
Right.
Ah.
Right.
Think about that
the UK used to be part of the EU, and it was part of Brussels review. It got, glommed in with all the other EU countries that were part of that. There were thresholds that could be triggered in just the UK previously, even before Brexit, but most big deals were assessed by the EU and not by UK.
Oh, well, that maybe makes Brexit all worth it then. to get to review deals.
Yeah, destroy the economy, but review deals. By the way, in terms of not political, I'm looking at the FTC board here. Lena Khan, it says she's a Democrat, right? Went to Yale Law School, by the way. Rebecca Slaughter, she's a Democrat.
That's right.
Went to Yale Law School, by the way.
Oh, I'm sensing something.
Alvaro Bedoya, he's a Democrat.
Also a Democrat.
Went to Yale Law School, by the way. What's the deal? I mean, if it's not political, why do they stack the board with Democrats who went to Yale?
Well, any administration, right, can appoint commissioners, right? And there are 5 commissioners, and no more than 3 can be from one political party. So generally, when we have a Democrat in the White House,
the other 2 spaces are vacant.
The other 2 are vacant, right? Now, there's some talk of nominees and appointees coming, right? But there's really no pressure on Biden to do that and move forward with that. I think he probably will, but at the end of the day, it doesn't really matter because it requires a majority vote. So when you have 3 Democrats and 2 Republicans, which you'll eventually have once those 2 spots are filled, you're still likely going to have the majority vote be along the Democratic lines. And these 3 have pretty much aligned on almost everything so far.
And in my world of media and telecommunications, it's the Federal Communications Commission, and it's the exact same gig.
Situation.
Whoever's in power gets the gets the role there. And Yale, is Yale the best law school? most rankings,
certainly on the left.
I don't know. Apparently, they like the antitrust regulators.
But don't they go on the rankings? Isn't it? I guess it's Yale.
I think it's up there. I don't know.
But
I think it's up there. Look, it's Yale.
Yeah,
of
exactly.
course it's great.
Exactly. All right. So what else on the antitrust front are you looking at here? What are some of the big trades out there that still need some approval?
Well, we're looking at Adobe Figma. Now, that obviously one is a private company, but that's been sort of lagging. I suspect the DOJ is likely to challenge that deal. We're waiting for Kroger and Albertsons. That's before the FTC. I wouldn't be surprised at all if the FTC went to court to try to block that deal as well. And trial will start in October in the JetBlue Spirit deal.
See, who cares? I mean, JetBlue and Spirit, do we care? I guess if you're in the markets that don't get a lot of service, and you care about, I want both JetBlue and Spirit to serve my market.
I mean, they have 2 very different models, right? JetBlue is considered a low-cost carrier, whereas Spirit's ultra-low-cost, which really means everything's a la carte, right? You can get the absolute cheapest fare without any other perks, no food, no luggage, nothing else, and you can't pick your seat. There is a set of consumers that prefers to have that option, right, for when they travel, and what will happen is that this deal, at least the allegation is, will take that option out of many markets, or reduce the option from 2, which were Frontier and Spirit, down to just 1, which would be Frontier when JetBlue takes over.
On the other hand, it's hard for JetBlue and also for Spirit and Frontier to compete with the duopoly that we essentially have here, right? You've got Delta, United, and American who hog all the slots.
You know, and
that's what JetBlue says.
Right, and that's their argument. And that's been an argument in airline mergers with some of the low-cost carriers and the ultra-low-cost carriers in the past. I will say that in 20 years that I've been watching this, the argument that we need to merge in order to better compete with the top guys never seems to work. It just doesn't really work, because if you take that merger on its own and it's anti-competitive and might have a price increasing effect or an output reducing effect, it doesn't really matter that much. It can't be outweighed by that argument.
I'm looking at the Spirit map. I mean, they fly pretty much everywhere. I mean, including the Caribbean and Central America and stuff like that. So it's a much bigger, more denser map than I thought. So,
but only in this, essentially, only in sort of North America.
Yeah, right. North and Central America. Yeah, so not any international stuff other than.
And JetBlue is now branched out. So now they go to London, they go to Amsterdam, and they go to go I believe.
Yeah, but that was hindered a little bit because the Department of Justice challenged their Northeast alliance with American, right, which kind of hindered some of that.
All right, Jen, thanks so much. We appreciate it.
Thank
Jen
you.
Reese, Senior Litigation Analyst, Bloomberg Intelligence. Right now, let's head down to Washington, D.C., World and National News with Nancy Lyons.
Thanks, Paul. Attorney John Eastman, one of the 19 people indicted in Georgia on state charges for allegedly pushing to overturn election results, well, he's surrendered in Fulton County. He's one of the first to turn himself in with a deadline of midday Friday. Bloomberg's Jody Schneider says former President Trump plans to report on Thursday.
He will be surrendering to authorities in Atlanta. He will have a mugshot. It is his fourth appearance on criminal charges this year, but obviously it's different in state court.
Bloomberg's Jody Schneider. Trump's bond has been set at $200,000. U.S. companies say they will be ready for new green reporting rules that require them to outline their climate impact. We get more from Bloomberg's Amy Morris.
69% of corporate leaders surveyed say they're prepared for pending disclosure rules. Half say they see climate change as a risk to their businesses. And while most are watching how the SEC finalizes climate disclosure rules, they're focusing more on European requirements. They take effect next year for large listed corporations, under which they'll have to report a broad range of sustainability issues, including water resources, climate, and their financial risks. Companies are still figuring out how to track and report those metrics. Amy Morris, Bloomberg Radio.
It's up to a federal judge in Texas to decide whether to remove a floating buoy barrier that Texas officials installed on the Rio Grande to stop unauthorized border crossings. Judge David Ezra is hearing arguments today from both sides. The Justice Department, in a lawsuit filed last month, argues the buoys constitute an unauthorized and illegal structure obscuring U.S. waters. Texas officials say the federal government has failed to secure the state's southern border and has a right to defend itself. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story, and sources tell Bloomberg Thoma Bravo will close its $2.3 billion acquisition of ForgeRock this week after the Justice Department declined to challenge the deal. That headline on the Bloomberg Professional Service. ForgeRock shares up 5.6%. ForgeRock makes identity verification software. Stocks are trading mixed right now. Choppy session. We do have the S&P lower, little change now, down by 3 points, down less than 0.1%. The Dow down 123, a drop there of 0.4%. NASDAQ, the composite index, up 30 points, a gain there of 0.2%. The NASDAQ 100 index, though, lower by less than 0.1%, little change. 10-year yield 4.33% with a 2-year that is now yielding 5.02%. Spot gold up $2.50 the ounce to $18.97, up by about 0.1%. And West Texas Intermediate crude up 0.1%, $80.32 a barrel on WTI. Wall Street is awaiting the latest numbers out of chipmaker NVIDIA tomorrow after the closing bell. NVIDIA's report is set to be a big test of AI fervor. Brian Crawes is the president of Scharf Investments, and right here on Bloomberg Markets, he told us he'd be looking elsewhere.
Everyone's holding their breath for NVIDIA, for example, but while NVIDIA is a great company, the expectations built into NVIDIA are substantial, so you need to see really great growth over the next 5 years to justify the price, where there's a lot of stocks that are trading at much lower multiples with much lower expectations that will probably outperform in the end.
And right now, NVIDIA is down by 2.5%. By the way, you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Lots of retailers out with earnings today. Among them, Macy's. That stock now lower by 13.1%. Lowe's, the home improvement retailer, up 3.8%. And after earnings, Dick's Sporting Goods down now by 24.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio, streaming live on YouTube. So just head over to youtube.com and search Bloomberg Radio. One of the areas of the market that we've been talking a lot about over the last several years, increasingly so, is the private credit market. We all know about the private equity business, but the private credit business has been been getting a lot of capital flows and has been very active. I want to get a little bit more details on that market. Jackie Ward joins us. She's the director of private investments for UMB Bank Family Wealth. She joins us via Zoom. Jackie, talk to us about how you guys at UMB, address and deal and play in the private credit business.
Absolutely. Thanks for having me. Here at UMB, there's a number of different ways we kind of play in the private credit business. In my world, we have a couple of bank-owned funds that invest in private credit. So we're regularly looking at opportunities in the private credit space, mezzanine debt, junior lien debt, and working with companies that way. From UMB Bank standpoint, as a senior lender, we also often work with junior capital providers to fill out the rest of the capital stack. So we get to interact with private credit, whether it's from a senior position or actually doing investment in private credit ourselves.
So my understanding is the private credit business really kind of took hold in terms of growing after the great financial crisis, when a lot of the banks, from a regulatory standpoint, had to pull back a little bit from certain types of loans in terms of what they could own on their balance sheet. Is that still the primary driver of what's driving the growth of this business?
I think it's a little bit of both. I think 2008 put private credit on the map because the question in 2008 was, when are big banks going to come back into lending? And I think the answer was it might take some time. And so you saw the launch of private credit. But these days, I think private credit is growing a lot just around direct lending efforts. Also, as banks kind of tighten in general, you're seeing less senior stretch debt. You're seeing more debt fall into the private credit space. And you're also seeing unitranche financing become a huge spot of the market. So with syndications down in general, a lot of companies are looking for a single provider that can provide a senior junior credit type blend through one instrument versus working with two different providers. And that's driving a lot of growth as well.
Jamie Dimon, I think, probably talking his own book, but, he kind of says, hey, this private credit market's not regulated. Do we really know what's going on out there? How do you respond to that?
You know, private credit, these are funds. They're regulated as funds and asset managers. They're not regulated by bank regulators. I think there's a few different ways to look at that. One, they're not regulated by bank regulators because they have a different source of funds. So private credit funds are raising money directly to invest in private credit as opposed to using depositor money. And because of that, they're able to take a little bit different outlook and potentially a longer point of view. I do think with any private investment, you know, the lack of regulation makes it really important to know who you're working with. You know, private credit funds that have long histories or attached to institutions like UMB that have long histories tend to do well because, of course, we're working with a broader market. I think it just goes back to diligence and knowing who you're working with and who you're investing your dollars with.
What types of deals are you guys seeing these days?
You know, in our group, we're seeing a lot of deals in the manufacturing distribution space, especially in distribution where you might be dealing with an asset-light company that still has a lot of working capital needs, a lot of growth. We're also seeing a lot of bolt-on deals. So in our portfolio, the vast majority of our companies are platform companies. So we're actively looking for new opportunities and looking for M&A opportunities. And it's a great way for us to put in more junior debt. So with bank credit kind of tightening, some of that senior stretch debt falling into our space is creating a lot of opportunity in both of those industries.
And do most of the deals that come across your desk, are they private equity sponsored deals primarily?
Yeah, we work primarily with private equity sponsors as well as, you know, LBO type funds. We're often working with them or independent sponsors where they're taking down the entire opportunity and they're looking for partners in the capital stack.
Interesting. So what is deal flow like these days? Because we've heard from, you know, some of the larger publicly traded investment banks that not a lot getting done per se. What are you seeing in your market?
You know, we work kind of in the lower middle market and we're actually seeing a lot of opportunity. Most of the deals that we're investing in, you know, we're looking at enterprise values of 100 million or under. And activity in that space, you still have a lot of companies owned by generations that are looking to make exits. You still have a lot of companies that are seeing an opportunity for M&A. So we're still seeing a good number of deals in our space. I think as you move up market, the markets get a little bit tighter and a little bit harder to raise debt. So we're very happy to be in the space we're in.
And you guys, UMB, you're based in Kansas City, right?
Yeah.
And so do you try to lend your regional expertise to the private equity sponsors out there, the companies out there? Is that kind of where you guys, kind of do your knitting?
So, you know, we get to work with the private equity groups in a lot of different ways. We have ways on the commercial bank side that we work with our private equity groups. Our bank is largely located, you know, Midwest focused. Groups like mine, we operate coast to coast working with different private equity sponsors on direct investment in their deals, either using mezzanine or minority equity. But we often, you know, UMB Bank is one large family. So we're often working with all the different divisions, you know, in concert to make sure that we're looking at the deal the right way.
Interesting. So here we've got a big increase in the interest rates over the past 12 to 18 months. How's that impacted your business? Maybe what kind of deals you see, what kind of structures you put in place?
You know, in our world, a lot of our deals, you know, slightly higher interest rate, interest only, we still have a lot of room and flexibility on that spread. I know one thing that we're watching just in the market in general is private credit is doing really well right now. I think there are a lot of funds that might have put out notes 12 to 18 months ago in a different rate environment. So we're keeping a really close eye on defaults coming into the back end of this year and early next year to make sure that doesn't have an impact on them. But kind of going back to the source of funding for a lot of private credit, because we're not utilizing deposit dollars in that sense, we have a different kind of cost structure that we get to compare against, and that gives us a little bit more flexibility.
And so for your funds, who's a typical investor?
For our funds, so on our family wealth side, we do have a number of single asset holdings that tend to be institutional and high net worth. The primary fund we invest private credit out of is a bank-owned fund. And so a number of years ago, the bank seeded us with cash, and we've been recycling that capital since.
All right, fascinating stuff. Always love talking about the private credit business. Again, a fast-growing business within financial services. Seemed to spring out of nowhere after the great financial crisis, and now it's a major player. Jackie Ward, she's the director of private investments at UMB Bank Family Wealth, located in the great city of Kansas City, Missouri, Kansas City, Kansas. I'm not sure how that all plays out between those two folks, but always love going to Kansas City. Looking at the market here, S&P 500 absolutely unched on the day. We got the Dow off about 0.4%. The NASDAQ pretty much up 0.25%. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Microsoft's $69 billion acquisition of Activision Blizzard has a new chance at winning approval from UK regulators after the tech giant submitted a substantially different deal to the country's antitrust watchdog. Now, Bloomberg's Alex Webb has the details.
So what Microsoft is now offering is the licensing of its cloud gaming offerings, of Activision Blizzard's cloud gaming offerings, to Ubisoft, a big competitor in the space. In the UK specifically, it has been about cloud gaming. Could Microsoft get a dominant position? It's offered now a concession that is aimed at least at reducing some of those concerns.
Now, the Phase 1 probe will now restart, and the CMA set a statutory deadline of October 18th. Shares of Microsoft right now up about 0.5%. Shares of Activision Blizzard, they're up about 1%. And Amazon.com is deploying its Pay by Palm device to more retail locations, but not everyone's happy about it. Bloomberg's Steve Potus explains.
It's becoming more common, consumers using their hands or faces to pay for purchases. But while companies hype the ease of biometrics, privacy advocates have raised concerns about the risk of information being stolen. Digital rights group Fight for the Future is organizing an online petition calling on grocery stores to resist Amazon's palm scanning technology.
Amazon shares right now up just a fraction. And IBM will sell its weather services, such as Weather.com, to Francisco Partners for an undisclosed amount. The technology-focused private equity firm will operate it as a standalone company. IBM will keep its sustainability software suite. Shares of IBM right now down a fraction. Those are the company stories we're making this hour. I'm Lisa Mateo.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio looking at these markets. S&P 500 unchanged. Dow Jones Industrials off 0.3%. That's 100 points. NASDAQ up 0.25%. On the yield front, 2-year Treasury, that's up 2 basis points, 5.02%. We were up at 5.04 earlier today. So marked move in the short end of the curve. 10-year Treasury pretty much off about 1 basis points, 4.32% here. So we'll keep an eye on that. Right now, we're going to head down to Washington, D.C. and get world and national news with Nancy Lyons.
Thanks, Paul. The first of 19 defendants in the Georgia election fraud case has turned himself in. John Eastman, the conservative attorney who pushed the plan to keep Donald Trump in power, has been booked at the Fulton County Jail. The district attorney has accused him and the others of scheming to subvert the will of Georgia voters and to keep Joe Biden out of the White House. Former President Trump says he'll surrender to Georgia authorities on Thursday. President Biden and First Lady Jill Biden are back in Nevada vacationing after a trip yesterday to see the devastation in Maui. Biden promised those impacted by the wildfires the government will be there throughout the recovery. Lahaina resident Kayamona Bramell is hopeful.
His words will be hollow unless there's action behind it. So when he says, I'm behind you, Washington is behind you, the country is behind you, we all hope that those words come true.
Bramell says she was impressed that Biden listened to their concerns. The administration has appointed a special coordinator to handle recovery efforts. UAW workers throughout the country began voting today on whether to go on strike against the big three car manufacturers. Bloomberg's Anne-Marie Hordern says the White House will be watching.
Those workers are going to vote whether or not to authorize their leadership to put a strike on the table for leverage. And that would just up the ante in these negotiations and also potentially draw some stressful conversations here at the West Wing.
Bloomberg's Anne-Marie Hordern. The 43,000 union members are seeking higher pay and a new two-tiered wage system, which would pay new hires substantially less. They're also seeking a return to cost of living adjustments and pensions for all workers. The union contract expires September 14th. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Matt.
All right, Nancy Lyons, thank you so much. We appreciate it. Looking at the shares of Dick's Sporting Goods off 24%. I mean, just an extraordinary move here. This is a $9.6 billion market cap company, so a big move there. Dick's Sporting Goods sank after cutting its profit outlook for the full year as the retailer deals with slowing growth and more theft at its stores. Chief Executive Officer Lauren Hobart said earnings for the second quarter fell short of expectations due, quote, in large part to the impact of elevated inventory shrink, end quote. That's an industry term that refers to factors such as shoplifting, employee theft, and damaged goods. Comparable store sales, a key gauge of retail performance, also trailed analyst estimates in the period. The slowdown in Dick's is another piece of evidence which suggests consumer spending is under a bit of pressure. Neil Saunders, an analyst at Global Data, said in a note to clients on Tuesday. As I said, the shares fell as much as 25% in New York, their biggest intraday drop in 3 years. Before Tuesday, the stock had surged almost 600% since the end of March 2020. This is Dick's first hiccup in a number of quarters and puts them in the penalty box, Will Gardner, an analyst at Wells Fargo, said in a research note. Dick's has been one of the retail's biggest winners of the pandemic, buoyed by strong demand for athletic wear and sports gear. Hobart has been opening more stores and adding square footage, including new experiential retail spaces with activity areas like putting greens and climbing walls. Now, cost cutting has taken on a bigger focus. Dick's lowered its forecast for capital expenditures this year and also laid off about 250 employees from its corporate workforce. A person familiar with the matter said customer support jobs were most affected by the job cuts. Again, Dick's, DKS is your ticker. It is off 24.3% today. The stock trades at $111.30 a share, so a big move in that name. S&P 500 today off about 0.1%. The NASDAQ up about 0.1% as well. Sound On with Joe Matthew. That starts right now.
pressure as it comes off its worst week since November because Treasury yields are sitting around multi-year highs, posing a challenge to many risk assets.
So we'll have more on the price action. Plus, we speak with EY Global blockchain leader Paul Brody about the potential approval for Ether futures ETFs.
And Coinbase takes a stake in Circle and dissolves the group governing the stablecoin USDC. We'll discuss what that means for the regulation picture.
All right, so all of that is ahead, but first, let's get a snapshot of the market. The best way to do that on your Bloomberg terminal, CRYP Go. And what you will find is we are seeing continued pressure on Bitcoin. Matt, it was just a week ago today, I was standing here doing this show talking about how we'd been hanging out at $29,000-ish for weeks on end, and then that all changed over the course of the last week. We actually had a break below $26,000 earlier in the session. We're basically hovering right there at that level right now with Bitcoin down about 0.3%. It's even worse for some of the other digital tokens. Ether down by about 1.4%, and Polygon, one of the big underperformers today, off by around 4.5%. What is interesting, Matt, is to see Coinbase kind of shirking off the broader downward pressure